Good evening, everyone. By introduction, I am Saurabh Singhal. I am a chartered accountant. I have also done LLB. I am a law graduate. I welcome you all to the virtual coaching classes organized by Board of Studies of ICAI on paper 8 Indirect Tax Laws, and the topic for today is Foreign Trade Policy. Now, up till now, in respect of indirect tax laws, we must have discussed, and I was also a part of few sessions in that, uh, basically goods and service tax. And then you must have also discussed customs law. Now, both goods and service tax and customs law are part of the regime of indirect taxes, and they both come under the Ministry of Finance. So, if we are to track the hierarchy of the indirect taxes in terms of GST and customs, it would be like Ministry of Finance, then CBIC, which was earlier called CBEC, Central Board of Indirect Taxes and Customs, and then you have these laws, wherein you have a separate GST department and you have a separate customs department. Now we are moving on to a different aspect, or I should say an allied aspect of indirect tax law, which is called the foreign trade policy. Now, unlike the taxing statutes, that is the customs law and the GST law, which used to come under the Ministry of Finance, administered by the Ministry of Finance, this one is not a taxing statute. It does not tax you anything. It is not for levy of any taxes, but it is for regulation administration of our foreign trade. And because it is for regulation administration and not for taxation, that is why the ministry concerned here is Ministry of Commerce and Industry and not the Ministry of Finance. Had it been a law for imposition of any taxes, for levy of any taxes, the ministry would have had been the Ministry of Finance. But this is more towards regulation and administration of foreign trade, along with some benefits under foreign trade. And that is why the concerned ministry is Ministry of Commerce and Industry. Now, though the topic is called foreign trade policy, this policy comes under a separate legislation. And this is the primary legislation concerning foreign trade. So this legislation is the most prime legislation under which there will be some policies, there will be some procedures, many other things. So this legislation that I am talking about is called the Foreign Trade Development and Regulation Act 1992. In short, in common parlance, it is also called as FTDR Act. Now this FTDR Act, if we go through the statement of reasons of this FTDR Act or the preamble of the FTDR Act, we would get to know that this act provides for the development and regulation of foreign trade by facilitating imports. Now understand these words. This is facilitating imports and augmenting exports. So they have to make the imports smoother and encourage exports, not just make exports smoother, but also encourage, augment exports from India and other connected matters incidental thereto. Now, basically, under the FTDR Act, the legislature makes provisions for facilitating and controlling foreign trade. It may also make provisions for prohibition, restriction, regulation of exports and imports. Foreign Trade Development Regulation Act also contains provisions which empowers the central government to come out with a policy, which is called the foreign trade policy. So, policy is under this act. Under the act, the central government is empowered to issue a foreign trade policy. And the act also provides for appointment of a DGFT, Director General of Foreign Trade, who is the head of the Foreign Trade Department, who manages, administers, governs, controls the various provisions of foreign trade policy. So basically, DGFT is nothing but the department, like CBIC for taxes of GST. Similarly, for FTP, the department is DGFT. And that is what this Act provides for. Now, though the Act is a long one and it contains various other provisions, today what we are concerned with this Act is the provisions relating to foreign trade policy. Now, Section 5 of the FTDR Act 1992 provides that the central government may from time to time formulate and announce by notification. So this policy is not just a policy document. So it is not a policy, so to say. It is a proper notified document by notification in the official gazette, the foreign trade policy, and may also in like manner amend that policy. Provided that, and this is important, provided that the central government may direct that in respect of SEZ, the FTP shall apply with such modifications, exceptions, and adaptations as may be notified. Why is this paraphrase or paragraph or these lines are there under Section 5? Why? Because earlier the provisions relating to SEZ, Special Economic Zones, were part of the foreign trade policy. But with effect from 2004-2005, the provisions of SEZ or provisions relating to SEZ were taken away from the foreign trade policy document and put on a separate legislation called the SEZ Act 2005. And that act, as we all know, is a notwithstanding act, is an overriding act. And that is why it says that the central government may direct that in respect of SEZ, for which there is a separate legislation now, effective 2004-5, the FTP shall apply with such modifications, exceptions, or adaptations as may be notified. So that is the relevance of this line. Now, usually foreign trade policy under the FTDR Act, Section 5, is issued for 5 years. So it's a policy document containing various provisions valid for 5 years. Earlier or formerly, this was called as EXIM policy because this policy was a very narrow policy dealing only with items of export and import. But now it has a wide gamut. That is why the name has changed to foreign trade policy. The latest policy that we are sitting on is the policy for the year or for the 5 years 2015 to 2020. When I say 2015 to 20, that means it is applicable from 1st April 2015 to 31st of March 2020. However, on account of this continuing pandemic of COVID-19, the government has not been able to bring about a new foreign trade policy in the month of March 2020. Because of which, the foreign trade policy for the year 2015-20 has been extended. And has been extended to what? Has been extended to 2021. So foreign trade policy for 15-20 has been extended to 31st March of 2021. This was one of the amendments that you have to remember as part of your November 2020 examination. So this notification has come only lately, prior to 30th April 2020, that the foreign trade policy for the previous 5 years is now being extended to next 1 more year. So the next policy for 5 years will come only on 1st of April 2021. Now, some basic features of foreign trade policy. Foreign trade policy does not override tax laws. That is, it is just a policy document, though it has power of the law. But in case there is a specific provision in a tax law which is inconsistent with the foreign trade policy, what shall prevail? The tax law shall prevail. That law shall prevail, not the foreign trade policy. One of the features of foreign trade policy, and I am talking about our foreign trade policy, that export and import of goods and services should be generally free. Why? Because we are moving towards a regime where world is a global village. And therefore, there should be free flow, there should be free movement of goods and services amongst nations. So that is the basic premise of our policy, although it is obviously subject to certain exceptions. One of the basic and the very basic principle of foreign trade policy that we have in India and mostly many of the countries who are part of WTO is that while exports or at the time of exports, only goods or services should be exported, not the taxes. So whenever a person is exporting goods or services out of the country, care should be taken. It should be ensured that by whatever provisions, all the taxes in the value chain till the time the goods or services are exported are refunded back to the exporter. Now our foreign trade policy also provides for easy custom clearance and anytime custom clearance. So there are also provisions of the foreign trade policy which provides for 24/7 custom clearance at some specified ports. Another feature of our foreign trade policy is that our foreign trade policy provides for single window clearance. So exporters and importers, exporters for filing shipping bill and bill of export, and importers for filing bill of entry will be given or should be given single window for all the documents that they have to submit so that their clearance process is simpler. Our export policy or our foreign trade policy also provides for provisions wherein shipping bills can be processed before actual shipment. How is this relevant? Suppose if I want to ship goods today. Now, if I take the goods to the ICD, the inland container depot or the nearest seaport or the airport and file a shipping bill, and if it takes 1 day or 2 days for the shipping bill to be processed, my goods will be delayed by 1 or 2 days. And that is what I do not want. So the policy provides that shipping bill can even be processed 7 days or 14 days in terms of sea shipments and 7 days in terms of air shipment and ICDs prior to the actual movement of goods. So you can have a prior clearance of your shipping bill so that at the time when your ship is ready or your aircraft is ready or your railways is ready or your truck is ready, at that point in time there should be no hindrance in terms of any clearance pending at the customs part. So that is one other basic principle or feature of our foreign trade policy. Now with the latest development and with the latest ruling government, we also have one more feature which will reflect in various parts of the foreign trade policy, that is Make in India. They always want to promote people to make in India. Now, who administers provisions of foreign trade policy? As I told you, the Department for Foreign Trade Policy is called DGFT, headed by the, again, Director General of Foreign Trade. It is a department of the Ministry of Commerce and Industry, Government of India. Now, DGFT as a department has various branches located all throughout the country. Like we have a RA office, they say it is, in general parlance, they are called regional offices. The regional offices, one is there in Delhi in ITO, that is in central Delhi. And then there are various RA offices all throughout the country at various states. Whereas the headquarters is located near the Parliament building, near the Central Secretariat at Udyog Bhavan in Delhi. Now another provision or feature of our foreign trade policy is that foreign trade policy, in terms of foreign trade policy or for matters related to foreign trade policy, the decision of the DGFT department is final and binding. What does it mean? In legal terms, it means that you would find in case of any orders passed under foreign trade policy, if you are aggrieved by the order, you will have an authority within the DGFT department who will listen to your first appeal, and there would be no provision for a second appeal. And for a second appeal, you have to actually go to the High Court under a writ petition. So this is the impact of it, this line in the legal terms. In legal terms, you will have a first first appellate authority or a first remedy, first appellate remedy or a first review remedy or a revision remedy. But all that will be contained within the DGFT department. You will not have a specific tribunal for it. You will not have specific courts for listening to the appeals of DGFT, because they say the decision will be final binding of the DGFT. And in case you are really aggrieved by the order, then the last resort that you have is go to the jurisdictional high court under a writ petition. Under a writ petition. Now, foreign trade policy, the basic administration is by the DGFT department. But there are allied departments also connected with the foreign trade policy, like CBIC. Why am I saying CBIC? Now, CBIC has two departments, Customs Department and GST Department. Many of the provisions of foreign trade policy you would find have their backing, have their legal backing or legislation contained in the customs law. So that is why customs law is also, or the CBIC department is also entangled or engaged in the administration of foreign trade policy. Many provisions you will find for effecting the provisions of foreign trade policy are there in GST law, like section 147 of the CGST Act, deemed exports, like section 16 of the IGST Act, exports without payment of tax, exports with payment of tax, refund of input tax credit for exports. So all these are what? Provisions in line with the foreign trade policy. So that is why they say, or that is why we can say that foreign trade policy is not just administered by the DGFT, but also partially by CBIC in terms of GST department and customs department. Also partially by RBI, because it is the central bank in India, and RBI controls all the money flow between other countries and India. And obviously foreign trade policy deals with that money control. So that is regulated through various RBI circulars, master directions, and orders. Similarly, state GST also is involved because under GST law, central GST and state GST have to work in tandem. So in that respect, even state GST departments are involved in the administration of foreign trade policy. Now we see, or if we go to the contents of foreign trade policy, the foreign trade policy contains 9 chapters. How many chapters? 9 chapters. Now, first and second chapter of the foreign trade policy is nothing but the basic provisions of imports and exports. The basic framework is there. So some general provisions are contained in chapter 1 and chapter 2 of the foreign trade policy. Again, foreign trade policy does not have sections and subsections and clauses. Because it's a policy document, it is chapters and paras. So whenever you use the or you refer to the foreign trade policy, you don't refer to sections, you refer to paras and chapters. Unlike in various taxing statutes where the second section is the definition section, in foreign trade policy, 9th chapter is the chapter for various definitions for words used under the foreign trade policy. Now, if you consider foreign trade policy as an act regulating and administrating foreign trade, this act should have some rules also to set out certain procedures. Those rules are not called foreign trade policy rules. They have a different terminology, and the terminology is Handbook of Procedures. The word is self-explanatory, Handbook of or Ready Reckoner of Procedures. So, the rules for foreign trade policy are also issued for 5 years, 2015-20, are also extended till 2021 on account of COVID-19 pandemic, and they are issued under or in line with or under the powers given under para 1.02 of the foreign trade policy. Now, foreign trade policy and Handbook of Procedures, that is the act and the rules, has a very specific scheme. Both of them are divided into 9 chapters. And each chapter in HBP, and we call it HBP in short, deals with the corresponding chapter in FTP. So that is the scheme. So if chapter 3 is for reward scheme under foreign trade policy, chapter 3 of HBP will be procedures for those reward scheme. So that is the framework of FTP and Handbook of Procedures. Now we all know appended to every rules are some forms. Under taxing statutes, we call them just forms. Under foreign trade policy, we call them Aryat Niryat forms or Ayat Niryat forms. Not Aryat, Ayat Niryat forms. Ayat is import, Niryat is export. So, Hindi turned into English, Ayat Niryat forms is the name given to the forms attached to the foreign trade policy. Then there are certain appendices also attached to the foreign trade policy, which will also contain some forms or some certificates, formats, or some things like these to be in line with the foreign trade policy and HBP. Now, along with the foreign trade policy and HBP and Aryat Niryat form is a document or is a manual, and that manual is called the Manual of Input Output Norms. So I am just showing you on camera a book specifically. This whole volume is specifically only for input output norms. What does it contain? It contains the generally accepted input output ratios of various types of goods that are or can be manufactured in India. That is the manual, and that manual is that huge because it contains basically input output ratios for all types of goods covered from chapter 1 to chapter 98 of the customs tariff law, of the customs tariff. What is their use? We will understand their use when we will go to the specific schemes. What is the use of standard input output norms? The word itself, although is self-explanatory, input output norms, that is input output ratios for various goods, and which is standard, which is basic, which is general, which is widely accepted. Now, also is a document called ITCHS. You must have heard of it time and again. ITCHS, Indian Trade Classification Harmonized System. Indian Trade Classification ITC, it is not input tax credit. HS in brackets, harmonized system. Why harmonized? Because our trade classification is based on a 8-digit level. So today we have a trade classification which is based on 8-digit level. So maybe chapter 84, chapter heading 8471, subheading 7190, and tariff entry 00. Like this, 84719000. Chapter heading, subheading, tariff entry. That is the kind of schedule that we have, the classification that we have under Indian law. Now, there is a common ITC or there is a common harmonized system given by WTO, agreed by all the member countries, which is at 6-digit level. Now, our country is aligned to that schedule as per the WTO agreement at the 6-digit level. So, this common classification which is used by all member countries of WTO will have the same goods at 6-digit level, be it United States, be it Russia, be it China, be it India. Whosoever is a member of WTO should recognize a product at 6-digit level at the same classification so that they can give equivalent and similar trade and tariff benefits in terms of classification of goods. Now, India adopts another 2-digit level for their own classification, which has nothing to do with WTO. Maybe US can have a 10-digit classification. Maybe China can have a 12-digit classification. You may have any number of classification over and above that. But at 6-digit level, all WTO countries should be at par, should be following the same schedule, same tariff classification. That is called ITCHS. Now, what is ITCHS? ITCHS under foreign trade policy is issued in terms of para 2.02 of the foreign trade policy. Now, it has two schedules, Schedule 1 and Schedule 2. And a word of caution here, you should not confuse ITCHS with Customs Tariff Schedule. Under Customs Tariff Act, in the first schedule, is the same classification that I am referring to at 8-digit level. But there, What is prescribed? The rate of BCD is prescribed. The rate of BCD is prescribed. This one, ITCHS being under the foreign trade policy does not prescribe any rate of tax. It prescribes whether the goods are free, restricted, state trading enterprises or prohibited. So if you will see the ITCHS, suppose this is the ITCHS, maybe I've given a screenshot also. Let me see. List of appendices. No. If you see the ITCHS, you will find in the ITCHS there will be this classification. Chapter 84, 71, ADPM machines. Suppose Chapter 84, 71, subheading 90, Pentium 4, then tariff entry 84, 71, 90, 00, then it says computer less than 14 inches. So this is the entry. ADPM is automatic data processing machine. 84, 71, 90 is Pentium 4 processor should be there. And at the tariff entry, so a computer less than 14 inches with Pentium 4 is a classification for 8471900. Now for the customs tariff, first schedule, you will have a BCD rate, suppose 10%. But under ITCHS, this schedule ITCHS, you will have written corresponding to this entry, either free. And you will have two schedules. One for all the 98 chapter goods for import, other for 98 chapters for export. In both the schedules, the word used will be either free, restricted, STE or prohibited. Free means free for import or export, whichever schedule the word free is written. Restricted is, it is free, but restricted subject to certain licenses that you have to take from the government. STE means state trading enterprises. It is free, but to be tradable only by state trading enterprises. Only state trading enterprises can deal in those goods. If ST is written in import, then import can only be done through state trading enterprises. If in export schedule, then export can only be done through state trading enterprises. And prohibited. Prohibited means no. No means no. We have all seen pink. No means no, which means it cannot be imported or exported as the case may be. Now, foreign trade policy uses three or four types of documents to provide for certain clarifications, notifications, amendments, and similar things. First type of document is public notices. They call it public notices. These public notices are to set out certain procedures. These are issued as per para 2.04 of the foreign trade policy. This is that screenshot for, which I should have placed earlier. This is that screenshot for appendices. What kind of appendices are attached to foreign trade policy? We discussed appendices and Aryat-Niryat forms. These are some of the appendices which are attached to the foreign trade policy. They contain the list of regional authorities and their jurisdiction. This is one appendix. So where all can you find that? Regional offices. Similarly, similar type of appendices. These are the list of Aryat-Niryat forms. Like form for applying for RCMC, form for applying for SEIS, form for applying for MEIS, form for applying for EPCG. So those forms are like this. I've just taken a screenshot of the book with the index for ANF. Now we were on public notices. So public notices are issued under the foreign trade policy to give out certain procedures by the DGFT. Whereas notifications are issued under 1.02 of the foreign trade policy to amend the foreign trade policy. Then they also issue documents. If you go to the GGFT website, you will find FTP, HBP, CION norms. Then you will have public notices. Then you will have notifications. Then you will have trade notices. Then you will have circulars. Trade notices are also to clarify certain provisions regarding the notifications and other clarifications. That is another instrument that is used by the foreign trade policy or the DGFT department. And circulars are also issued under the foreign trade policy. So these are the type of document that you may face when you are discussing or when you are reading the foreign trade policy or looking at the foreign trade policy. Now, as I told you, foreign trade policy is divided into 9 chapters. What are the chapters? The chapters are Chapter 1, Legal Framework and Trade Facilitation. So this will contain some legal framework provisions and provisions for trade facilitation. Chapter 2 is basically some provisions for regulating import and export. So these are general provisions, like how you have to get an IEC import export code, how you have to get an RCMC, how should imports be done, how should exports be done. So general provisions which you can read and understand. It's a simple English, basically simple English. Now chapter 3 is the chapter till chapter 7, wherein all the actual schemes of foreign trade policies are contained. And this is where the discussion lies. This is where we have to dig deep and understand what all kind of policies and benefits and rewards are provided for into the foreign trade policy. So that is the main material under foreign trade policy. Chapter 3 is for export promotional measures, so reward schemes. Chapter 3 is for reward scheme. There are 3 types of schemes in that chapter 3. First one is MEIS. Second is SEIS. Third is status holders. Those are there in chapter 3. Chapter 4 is for duty exemption or duty remission scheme, wherein certain goods, when imported, are free from duties, or if imported on payment of tax, the duty that you have paid is given back to the importer. Those are called duty remission. Remission means pay and get back, or duty exemption. That is no payment at the start itself. So chapter 4 is for duty exemption and duty remission, like DFIA, duty free import authorization, advance authorization. Those are the kind of schemes covered under chapter 4. Then chapter 5 is specifically for import of capital goods. This chapter contains provisions for a scheme called Export Promotion Capital Goods Scheme, EPCG. This is for duty-free import of capital goods for certain specified purposes. Chapter 6 is basically a status-based chapter. That is, it contains provisions as to how a unit can become a export-oriented undertaking, a electronic hardware technology park undertaking, or a software technology park undertaking, or a biotechnology park undertaking. And what are the benefits around becoming a EOU unit or a STP unit or a ESTP unit or a BTP unit? Those are the short forms for these type of units. So that is chapter 6. Chapter 7 is deemed export. Anything which is actually not export but deemed to be export. That is, the goods are actually not going to out of India, but they are within India. Even foreign currency is not received, but still they are deemed to be export for certain reasons. That is chapter 7. Chapter 8 is a small chapter for any complaints and trade disputes that people have under the foreign trade policy. In chapter 9, as I told you, is a chapter for definitions. Now our focus for today's class or today's discussion would be chapter 3 to chapter 7. So you also have a part, as your part of syllabus, chapter 1 and chapter 2 also is there in your part of syllabus, but that is only reading and learning. So you can read and understand. There is nothing much to be explained on. But chapter 3 to chapter 7 is the real material which should be explained, which should be communicated well. So for you to understand the scheme, because there is a lot of interlinkage between the schemes, and the schemes itself by themselves are very complex. So we will focus on the schemes. Now foreign trade policy from chapter 3 to chapter 7 provides for various export related schemes, export promotion schemes I should say. Now these schemes can be divided into 3 categories based on whether the scheme is pre-export, that is you can avail for this scheme before even exporting, or whether it is a post-export, that is you can avail for this scheme after you have exported, or whether those schemes are status based. If any status is what I have got, then I will get that scheme or that promotion. So these are the three categories under which we can divide the foreign trade policy. The first one being pre-export incentives. Pre-export incentives means incentives which are given to a person even before he has exported the goods or the services. The first one being advance authorization, wherein you can import duty-free inputs. Second one is DFIA, which is also akin to advance authorization, wherein upon import of certain inputs and export thereof, you get a duty-free or you get a duty-paid license, which can be used for duty-free imports. Then the third one is EPCG, that is for import of duty-free capital goods. For post-export, that is schemes which give you benefits after you have exported. The first one is duty drawback, which was the one which we discussed yesterday. Duty drawback, wherein somebody would import and then re-export, or import and use it for a manufacture and then export. Then whenever he has exported, a percentage of the value of the export or a percentage of the import duty paid will be given back to that person as duty drawback, duty refund. The refund of duty that that person must have paid at the time of import of the goods which are ultimately exported in one form or the other. Then you have a specific and a very categorical scheme called MEIS, Merchandise Exports from India Scheme. Merchandise means goods. Goods export from India scheme. So in case you are exporting certain types of notified goods to some notified markets, you get a reward benefit in the form of scripts. Similar is the scheme called Service Export from India Scheme, SEIS for services. Again, if you export certain notified services to notified locations, then you get a percentage of the export value as duty credit scripts, which can be sold in the market, which can be even used for payment of import duty on imports. Then the third one is status based. So if you acquire a status of an export oriented undertaking or a special economic zone, or you become a status holder. When I say status holder means you must have heard of this: 1-star export house, 2-star export house, 3-star export house. So that kind of status. So if you have any specific status in terms of EOU, and when I say EOU, I automatically mean EOU includes as EOU is a genre. Specificities are EOU, ESTP, BTP, and STP. Software Technology Park, Electronic Hardware Technology Park, and Biotechnology Park. So if you got a status of an EOU, if you've got a status of an SEZ, if you've got a status of a 2-star, 3-star or a 4-star export house, then also some benefits are given to you. We start with the first scheme, and this scheme is called Merchandise Export from India Scheme. Now I must tell you at this stage that the government has decided, though it is not part of syllabus, I am just putting it as a caution, that this amendment that I am speaking on is not part of syllabus. MEIS is a part of syllabus. This MEIS is towards its end. The scheme is towards its end. It is going to be replaced by another scheme. But for our exams, MEIS is relevant. So up till 30th of April 2020, up till when amendments have to be taken into consideration for November 2020 exams, MEIS is a valid scheme, part of syllabus. So what is MEIS scheme? Basically, this scheme provides for a reward benefit to the exporter of goods, to the exporter of notified goods to notified markets, if certain conditions of the scheme are satisfied. How is the reward given? The reward is given in the form of duty credit schemes. So suppose if I am an exporter of this mouse and I have exported 100 mouses in the financial year 2019-20, government will say 100 mouses into 100, that means 100 into 100 means 10,000 rupees. Now 10,000 worth rupees of mouses if I have exported, government will say on rupees 10,000, we will give you 2% back in the form of a paper, a reward script. It is called a script. And this script can be used for payment of BCD whenever somebody imports any type of goods. I'm using the word any type, but there is a list. Any type of goods into India. And this script, either you can use it for your own imports or you can sell it in the market. It is a holder document. It is a bearer document. So effectively, government has given you 2% of your export value cash back. It is like a cashback scheme. But why would government give us cash back without any correlation with anything in terms of any import duty? So usually get in foreign trade, in all these schemes that we will discuss, you will be getting some benefit because you have paid some import duty at the import angle, or you have paid some duty at the DTA inward. But this is a purely unconnected scheme. Whether you have paid duty or not, if you are exporting, we will give you 2% cashback. It's like an Amazon cashback offer. Why is it given? The question is, why is it given? If it is not related to any import duties or any cascading effect of duties, then why are these schemes given? Why are these benefits given? These are given to offset infrastructural inefficiencies and associated cost. So our government realizes and acknowledges that India does not have the appropriate infrastructure for the exports to be smooth, to be free from unnecessary costs. Because of that lack of infrastructure, exporters have to pay an extra cost while they export from India. So in order to bring exporters from India in line with exporters outside the country, so suppose there is a market in US and China is also exporting and India is also exporting. Now China has the appropriate infrastructure and suppose we do not have appropriate infrastructure. In that case, our government is saying that on account of that extra cost that you must have faced because of deficient infrastructure, we are giving you this 2%, 3%, 4%, whatever is the rate, as a cashback offer. And this should justify or satisfy your lack of infrastructure. So that is the objective and the motive and the reason behind the scheme. Now, Mr. Sumit Agarwal from Mathura has asked me, what is duty credit scripts mean? So duty credit scripts are like this. The way I'm drawing, like this. DGFT, Ministry of Commerce and Industry. Scripts. FOB value 1000 rupees. Scripts value 10% or 2% suppose. So 2% of 1000 rupees is 20 rupees. 20 rupees scripts. Now this script is worth rupees 20, which will be given to you if you export 1000 rupees of goods. Now with this document, you can show it to the customs department and import goods and pay 20 rupees worth of BCD by just showing this document. You don't have to pay cash. Or you can sell this document to somebody who is importing goods and he may be wanting to buy these goods, buy these scripts from you at rupees 19 or 18 or 17 based on demand and supply. Because by purchasing this 20 rupees scripts, 20 rupees worth scripts from you at rupees 18, he can pay 20 worth rupees BCD and save rupees 2. So there is some margin that is involved in this. So these are duty credit scripts which are issued against this scheme. Now what is the eligibility for MEIS? The eligibility of MEIS is that you should have exported notified products as per ITCHS code, that is as per the codes that is given in the Indian Trade Classification Schedule, to notified markets, and this complete schedule of rates and markets is given under Appendix 3B. It is not appendix, it is appendix. Appendix was for some list and procedures. Appendix are some schedules. Appendix are some schedules. So Appendix 3B, 3 capital B is the schedule which will list out the various goods, and the corresponding rate against those goods. So if I am to show you on camera I have a screenshot also. This rate schedule, it is like this. This one. So ITCHS 2017, ITCHS 2012. This ITCHS is also reviewed reviewed by the Ministry of Commerce every 5 years. So as per 2017, this is the HSN code. You can see here, it is an 8 digit, 2, 4, 6 and 8. This is the description and this is the MEIS rate, 7%. This is the kind of schedule that you have under Appendix 3B, B for Bombay, 3B. And in this very appendix are the name of the markets, country group A, country group B and country group C. And your MEIS rate depends on the country to which you are exporting. However, by way of recent 2-3 years back amendment, this country classification has been done away with. So today there is no country classification. Whenever you export a goods, you will be eligible for the rate corresponding to the schedule. There is no country classification, but there used to be a country classification also prior to 2017. There used to be one, but now it is not there. What is the benefit under the scheme? As I told you, you are eligible for duty credit CRIPS. What is the peculiarity of this scheme? The scheme or the benefit or the primary USP of this scheme, that these scripts that are issued are freely transferable. You can sell them in the market. There is a complete trade going on of these scripts, and you can very well sell them at 97% of the duty scripts amount. Now, how do you calculate this benefit? As we saw in the schedule in the Appendix 3B, it was 7%. But 7% of what? 7% of realized FOB value. Mind this, it is realized FOB value. It is not just that you have to export, you have to realize the money of exports in free foreign exchange, or FOB value of exports as given in the shipping bills in freely convertible foreign currency, whichever is less. Whichever is less. So in case you have received advance, you will not get scripts on the advance amount. You will get scripts on that advance amount whenever you issue the invoice for that amount, or you will issue the shipping bill for that amount, file the shipping bill for that amount. So they say, if suppose I have made an export of 100 crores in this year and I have only received 80 crores, I will get 7% of only 80 crores if the rate of MEIS on me is 7%. Bhavati Sukhadia from Vadodara has asked, what is DGCI? Ma'am, DGCI is a separate department. It is called DG, now it is called DGGST. It is not DGCI anymore. It is an intelligence department under the CBIC. Under the CBIC, it is an intelligence department which will take out fraudulent cases based on certain information. It has nothing to do with FTP. And it is not DGCI, it is DGCEI, which is now changed to DGGST. Now, what all types of exports are eligible for merchandise export from India scheme? If you export by vessel, if you export by air, if you export by rail, if you export by road, all these are eligible exports for MEIS scheme. If you export by courier or post office using e-commerce, you will be eligible, but only export of handicraft items, handloom products, books and periodicals, leather footwear, toys and tailor-made fashion garments to courier or foreign post office using e-commerce of FOB value INR 5 lakh per consignment shall be rewarded. So, if you are exporting by foreign post office or using foreign post office or post, and you are selling these goods on e-commerce, then your upper limit per consignment is 5 lakh. That too only on the goods that are specified here. So, if your consignment is 7 lakh rupees for such type of goods exported by post or courier, which are sold on e-commerce on a web portal, then even when your consignment value is 7 lakh, you will get MEIS only on 5 lakh. MEIS only on 5 lakh. So that is the restriction on export by foreign post office and courier for goods sold on e-commerce. It is allowed, but only on specified goods up to a value of 5 lakh per consignment. Now, what are the ineligible categories for MEIS in terms when they are exported. Sorry. So this is the provision for MEIS on e-commerce using foreign post office or courier is given under Appendix 3C. The same thing I have given here in simpler language. Now this was that schedule that we had already seen, wherein earlier there used to be these country groups which are no more there. They are there in the part of the schedule, but the rates are not now dependent on the countries. Now, what are the ineligible categories for MEIS? What all types of exports, goods or transactions are ineligible under MEIS? If somebody make a supply from DTA to SEZ, we refer to this type of export under drawback also, wherein under section 74 and 75, one allowed drawback for exports to SEZ, one did not allow. Similarly, for MEIS, they say if you are making an export to SEZ, so if you are supplying goods to SEZ, it shall not be deemed to be export for the purpose of MEIS scheme. You will not get this reward. Export through transshipment is another type of export which is not allowed for reward under this scheme. What is transshipment? If the goods start from one country and end in another country without even reaching India, just being transshipped through India. So they are not cleared in India, they are just transshipped through India. That will not deem to be export from India, and therefore there will be no rewards on that. Deemed exports, that is supply to EOUs, supply of capital goods to EPCG holders, supply of goods to advance authorization holders. All this also is not allowed for MEIS rewards. We have discussed this where section 147 of the CGST Act, deemed exports. Exports which are otherwise not physical exports, goods are not leaving the country. You are also not getting foreign currency, but you are giving them to specific type of people who are export oriented type of people who are basically engaged in export of goods. Those type of exports are called deemed exports. But this scheme says those artificial exports will not be covered under this scheme. So if I am a DTA manufacturer supplying goods to a EPCG holder or advance authorization holder or to an EOU, I am not eligible. We will discuss in greater detail what are deemed exports when we will come to chapter 7 of this FTP. Now, export products which are subject to minimum export price or export duty. Export products which are subject to minimum export price or export duty are also not eligible for MEIS. Why? Obviously, there is a good on which there is a export duty levied by the central government. Definitely it is not promoted for export. Why will government go for a reward on such type of export? So quite obviously. Then exports made by FTWZ units. What are FTWZ? Free trade warehousing zones. These are zones wherein goods can be imported and kept without payment of customs duty. And from there the goods are exported. So they say you have not even entered, so in a way you have not even entered India, you have come to a specific zone and you have just imported goods and exported without even making payment of customs duty. Hardly you must have faced any infrastructure inefficiencies of India, and therefore we do not want to, conscious call, we do not want to give any reward to you. So any exports done by FTWZ. Who uses FTWZ? Foreign trade free trade warehousing zone. Who uses them? People who import and export but do not want to pay duty. They can import in FTWZ and export without making any duty, any BCD. What are the other items ineligible for MEIS? Exports by EOUs, ESTPs, BTPs, STPs. They say you are otherwise eligible for various other benefits, you will not be eligible for MEIS. So if an export oriented undertaking is making exports, that those exports will not be eligible for MEIS. items which are restricted for export under Schedule 2 of export policy. We understood that Schedule 2 is for export policy. So if any item which has restricted, which is subject to a license, that item if exported is not eligible for MEIS. Red sanders and beach sand, specific goods. Similar are these other type of goods which are ineligible for MEIS. Last one is items which are prohibited. They are not giving on restricted only. Why will they give on prohibited item? Now comes the question that once you have exported these goods and have got the duty reward schemes, duty reward scripts based on the percentage of the FOB value that you have received during a year for export of goods, what do you do with these scripts? These scripts are freely transferable, as I told you. You can sell them in the open market. You can also use them for payment of BCD on inputs, goods, and some notified capital goods. Why is notified? Spares are actually not included. You can't pay BCD on spares when you use the scripts. You can also use these scripts. Suppose you got a script worth rupees 12 lakhs. Because 7% of whatever is the export value came out to be 12 lakhs, DGFT gave you a script of worth 12 lakhs. So you have a paper worth rupees 12 lakhs, which can be sold in the market, or you can use it for payment of BCD on any imports that you are making, or you can use it for payment of composition fee or any application fee under FTP. Under FTP, you have various application fees and composition fees to be paid. You can pay that also using these scripts. Suppose you have an export obligation, and we will discuss this export obligation, park this in your mind. Suppose you have an export obligation under FTP and you have not fulfilled it. If you do not fulfill an export obligation under a scheme, you have to pay customs duties. You can pay that custom duty also through this script. Even when you are importing goods from a bonded warehouse by filing ex-bond bill of entry, at that point in time also whatever BCD is payable, you can pay it through scripts. So sum and substance, scripts can be freely transferable. Scripts can be used for payment of BCD, but only for BCD and social welfare surcharge. That is the cess on BCD. Scripts are not taxable, not usable against payment of IGST or compensation cess. So whenever you import certain goods, there is levy of BCD, social welfare surcharge, IGST and cess. You can use the script only to the extent of BCD and social welfare surcharge. You can't use it for IGST and compensation cess. Second thing, whenever you sell a script, under law, scripts which are transferable are nothing but goods. So it is sale of goods. Under GST law, sale of scripts has been completely exempted from tax. So this can also be a question under law, under your paper, wherein somebody has sold the duty reward scripts to somebody else. So A, who was an exporter, sold the scripts to B, and for rupees 100. So what will be the GST rate? Nil. The tax rate has been changed. Only few years back, this tax rate has been changed in the year 2018 or 17, I suppose. It was earlier 5%. Now it is 0. And script sale is sale of goods. Now this is also very, very important. What is the eligibility of SENVAT and drawback? If you have paid certain duties using scripts, so suppose I imported goods and at the time of import BCD was payable, I paid BCD by making use of the scripts. Will the department say because you have actually not paid in cash and you have paid through scripts, you will otherwise not be eligible for duty drawback? And we all know that if you import for export, then whatever BCD you pay or other duties that you pay, 98% of that will be given to you as drawback. So even when you pay this BCD through scripts, this 98% is still eligible. This is what this provision says. The first point is no more relevant because basically you only pay BCD through this and for which credit is otherwise not available. So therefore forget this. But what is relevant here is Even when BCD is paid through scripts, this BCD is eligible for any type of drawback that a person is eligible of under Section 74 of Customs Act or Section 75 of Customs Act. Now, transfer of export performance. The provision provides that in case a person has exported good having an IEC, he cannot say that I am transferring all my export performance, all my export turnover, whatever I have made in the past few months, to another IEC, and now you grant scripts to this person. That is not allowable. Scripts are only given to a person in whose name shipping bill is filed, and in the bank account or in the name of the person who has the name in the shipping bill. How do you file for MEIS? What is the actual procedure for filing of duty reward scripts under MEIS? The first process is, and go to the process. The first process is, whenever you export goods, you file a shipping bill or a bill of export. Shipping bill in case of sea and bill of export in case of land export or air export. So whenever you file this export, bill of export or shipping bill, there are various type of shipping bills. One is free shipping bill, one is duty drawback shipping bill, one is duty drawback plus MEIS shipping bill. So you have to choose a shipping bill which has a MEIS tick on it or which has a checkbox for MEIS. You fill that shipping bill and you checkbox that you are claiming MEIS. And you mention the description and the HSN and the rate applicable of MEIS. Once you have done that, you club certain shipping bills, and we will go to that also, and file an application on the DGFT website with the RA concerned. So suppose I am in Delhi, my RA is in ITO. If I am in Rajasthan, my RA is in Jaipur. I file an application in so and so form, that is ANF 3A or 3B, Aryat Niryat form 3A, Aryat Niryat form 3D, depending upon I'm exporting through courier or exporting through other than courier. I will file an application giving details of all these shipping bills. And it is an online application. Now the question comes, suppose I am a person who is exporting goods from various locations all over India. How do I then file for MEIS? They say, in case you have more than one location from where you are making exports, more than one port from where you are making exports, then you may choose an IRA based on your corporate registered head office, branch office. Suppose I have head office in Delhi, corporate office in Haryana, branch office in 9 more states. I can choose any RA for one financial year. And whatever RA I choose, that RA will remain my RA for all the exports that I have made all throughout India. For all the exports that I made all throughout India for that financial year. So one financial year, one RA. You can't change an RA within the financial year. Now suppose I am an IC holder and I have a unit in DTA also, ESTP also, ASTP also. So I have a unit in DTA and I also have a ESTP unit or a BTP or a STP unit. Then my jurisdictional RA will be any RA as per my convenience based on my corporate office, registered office or head office. Suppose I am an IC holder and I also have a unit in SEZ and I also have a unit in EOU. Then my jurisdictional RA will be Development Commissioner of SEZ. Now you have to remember this. What is the difference? Let's not go to the integrities. The concept is, suppose my unit is a unit normal DTA unit or a ESTP, BTP or STP, not EOU. ESTP, BTP or STP or a DTA unit, then my RA is normal RAs with a DGFT office. But if any one of my unit also is an SEZ unit or a EOU unit or both, then I can't go to the DGFT department. I go to the Development Commissioner, who is a person who is a commissioner under the Customs Department, not the DGFT department. Why? Because SEZs are under the control of the Customs Department, that is CBIC, not DGFT. So whenever one of my unit, even one of my unit is with SEZ or EOU, is an SEZ or EOU, both of which are controlled by a development commissioner under the Customs Department, CBIC, then my RA is not the DGFT department but the Customs Department as given in Appendix 1A. Suppose I have both under DTA also and SEZ also. So for DTA units, I can choose a normal DGFT RA. For SEZ unit, all SEZ unit, I have to choose one Customs Department where I will apply MES. So I'll have to apply separately. So if DTA plus EST, ESTP, BTP, STP, then only normal RA, DGFT department. If all units in SEZ or UU, then development commissioner based on my office. Suppose UU and SEZ plus DTA unit, then for DTA and ESTP, STP, BTP unit, normal RA, DGFT department. For UU, SEZ, you have to go to the development commissioner. Then it is provided that MEIS reward script shall be issued with a single port of registration, which shall be any of the EDI ports from where the export is made. Now let us understand what are EDI ports, what are non-EDI ports. EDI ports are automated ports. Their shipping bill are filed online. The complete thing is automated, complete thing is online. Non-EDI ports are more of a manual port. So they say if you are making exports from 10 EDI ports, all ports in India are not EDI ports, from 10 EDI ports, then whenever we will issue a duty credit script, that duty credit script will be mentioned against a port. And you can only use that duty credit script against imports made under that port, in that port, or you will have to transfer the script. That is the provision. Then they say for shipments from non-EDI port, duty credit script to be issued with a single port of registration, which shall be the port of export. So if you have made the export through a non-EDI port, the port of registration of that script. So in the script, there will be a name of the port. In case your export is through non-EDI port, the name of the port will be that particular non-EDI port. And before you can use this script, you will have to register them at the port that they are mentioned with. Now suppose your exports are through EDI port and you have mentioned one of the EDI port as the port of registration. You can use the script issued against that export at any of the EDI port because all are electronically interconnected. But if your export is non-EDI port, then your script will be attached to that EDI port only. And in case you want to use the script in any other port, you will have to go through a process called TRA process, the transfer process of scripts from one non-EDI port to another non-EDI port. The only point why am I stressing on this topic is the only point of amendment. With effect from 10th April 2019, the facility to transfer any script from an EDI port to non-EDI port has been stopped. Meaning thereby, suppose you made export through EDI port, you got a script also with the EDI port registration. Now you can't, and you want to now use this script for payment of BCD at a non-EDI port, you can't transfer this script, which was earlier available, but now not available. Suppose you apply at you make export from a non-EDI port and get a script with a non-EDI port registration, and you want to use the script in another non-EDI port, that transfer is still available. Now, what is relevant on this slide is that an application can be filed for grant of MES with a maximum of 50 shipping bills. You can't give 500 shipping bills and say, please give me a scripts. The maximum limit of an MES application is 50 shipping bills. Now, what is the process of this application? Basically, you file an application. So the process is divided into EDI ports and non-EDI ports. In case of EDI ports, what do? You apply for this application online. No physical documents are submitted with the RBI or with the RA. Only an applicant has to submit the proof of landing, that the goods have actually landed at the foreign port. And single application for multiple shipping bill can be filed. Maximum 50 shipping bills can be clubbed in a single application. Whereas if you file an application for a export from non-EDI port, then you have to actually give the physical copy of the shipping bill file. So shipping bill will be in various copies of shipping bill will be there, and there will be one export promotion copy that has to be filed. And you also have to give a proof of landing. And you have to give a separate application for each non-EDI port. So in case of exports to EDI port, you can have one application for all the exports that you have made from EDI port. But if you are doing it from non-EDI ports, a separate application for each non-EDI port, because a separate duty credit script will be issued. Now, what do you mean by proof of landing? That is to be given in both the process. The proof of landing means the proof that goods have actually reached the foreign shores. Now, how do you give that? This is the list of documents which can be used to justify that the goods have actually landed at the foreign port. So this is you can read and you can understand what are all the type of documents. Now this is also practically very relevant. Whenever you apply for duty credit scripts under MEIS, under Merchandise Export from India scheme, the credit script amount is in the multiples of 5 lakhs. Multiples of 5 lakhs. Meaning thereby, suppose your eligibility for MEIS script is for 90 or not 90, 63 lakhs. So you can apply for a single script of 63 lakhs. Why will you apply for a single script? Because you know I have to sell it in the market. Why apply for so many scripts? Let's apply for only one script and we will sell in the market. I will be able to find a buyer for 63 lakhs. But suppose you think, no, it is very difficult to find a buyer for 63 lakhs. So you will apply for split scripts. Now the split scripts cannot be for 2 lakh, 3 lakh, 1 lakh. No, it has to be in the multiples of 5 lakh. So you can apply 5 lakhs, 5 lakhs, 5 lakhs, 15 for the 60, 5 lakhs, 5 lakhs, similarly till 60 lakhs. And the last script will be of 3 lakhs. The split amount is 5 lakhs. You may have any number of splits that you may like, but only split of 5 lakhs. One more point is that if you export through non-EDI port, facility of splitting of the script is not allowed after the issue of the scripts. Initially it is allowed, but after the issue of the scripts, not allowed. Whereas if you export through EDI ports, yes, it is allowed even after you have been issued the scripts. Now, what is the validity period for these scripts? Up till what time are they valid for payment of BCD or transfer? They are valid for 24 months from the date of issue. Whenever a script is used for BCD payment, it should be valid as on the date it is used, not just transferred, used. So as on the date of use by the person who has got it or to whom it is transferred, it should be a valid script on the date of used. Revalidation is not permitted. So you have to take care that you sell the script within 24 months. Now, what is the procedure for applying in terms of export? As I have told you, you take a yes on MEIS on the shipping bill. In case of non-EDI port, you have to write this declaration. We intend to claim rewards under merchandise export from India. I've told you this. Now, what is the last date to apply for the script? So the first step is that when you export, you make this declaration or click a tick or checkbox the tick. Second is you have to apply for this application. We have seen to whom to apply, but what is the time limit to apply? You have to apply within 12 months of the let export order date or 3 months from the date of uploading of EDI ship onto the DGFT server by customs. Printing and release of shipping bills for non-EDI bills, whichever is later. So they say within 12 months of the let export date or 3 months of the uploading of EDI shipping bills onto DGFT server, whichever is later, is the time limit for you to file MEIS script application for MEIS. So basically 12 months from the let export order date, because obviously EDI ship shipping bill will be uploaded much before that, and it is whichever is later. Now, suppose you do not file for application for MEIS before the concerned RA or SEZ Development Commissioner within the time limit, then what happens? Then if your application, suppose let export order date is 31st March in your case. So if your application is not filed by 31st of March 2021, but within 6 months of 31st March 2021, that is 30th September 2021, then there will be a late cut of 2%. Meaning thereby, if you are eligible for 1000 rupees scrips, you will be given 98% of 1000. If the application is late by another 6 months, that is till 31st March 2022, then you will be given 95% of the scrip eligible. And if for another 1 year, then 10%. But if you delay the script for more than 2 years, that is 1 year normal period and 2 years delayed period, complete 3-year period, then your script is time barred. You will not be able to apply for this MEIS reward. So the upper limit for applying for MEIS reward is 3 years from the date of let export order. Now, whether can you file supplementary claims? Why would there be a need of filing supplementary claims? Because MEIS scripts are eligible on the amount received against exports. Suppose within 3 years you have not received the amount at all, or when you applied for MEIS script you had not received amount for certain exports. Can you apply for supplementary claim? They say supplementary claim would be admissible under MEIS only for certain HS codes, for which rates under MEIS have been enhanced with retrospective effect based on guidelines issued in this regard. MEIS supplementary claim is not allowed generally. Only if there is a retrospective effect reward rate change is the MEIS allowed. Is the MEIS supplementary claim allowed? So this was all about merchandise export from India scheme. This was on goods exported out of India. Now we are moving to another scheme, and this is a scheme which is post-export scheme. We discussed this post-export scheme. We are going to the second scheme, which is called service export from India scheme. Now the scheme is fairly similar to what is MEIS. The objective, the reward rates, the application process, fairly similar. Just that some nuances have changed. Some ineligible criteria have changed. There is an additional service category on which SEIS is allowed. So except for some minor changes that we will discuss, more or less the scheme is changed. Just that instead of goods, now it is services. Let us see the scheme. Again, this scheme provides for reward in terms of duty credit scrips for services exported from India. For services exported from India. Now again, the reason is again the same, infrastructural inefficiencies. Now what is the rate of reward? The rate of reward is given under appendix. In MEIS it was appendix 3B, B for Bombay. It is now appendix 3D and 3E. We will see what is appendix 3B, 3D and 3E. These are appendix which would give out the rates of SEIS. Earlier, the reward was calculated on FOB value received in free convertible foreign exchange. Now the reward is calculated on net foreign exchange earned, NFE. Net foreign exchange earned. That is the basis for calculation of the reward rate. So suppose reward rate is 5%, then it will be 5% of NFE. Now this is very, very, very important. This one. Sorry. What all type of services are covered under SEIS? SEIS covers 2 types of services only. Basically, if I am to divide services by the way in which they are provided, By that manner, I can divide services into 4 categories. The first category being services which are provided sitting in India to a person outside India, also called Mode 1 services. These are eligible services. Second being supply of services from India to service consumers of any other country in India. So if a foreign tourist has visited India and to whom we have provided services and earned foreign exchange, those are also eligible services. Third is services provided by opening a commercial establishment outside India. So suppose for a construction project, I open a small establishment outside India. That is mode 3 services. Those services are not eligible for SEIS. Not eligible for SEIS. Fourth is services wherein a person from India has to travel abroad to provide the service. Suppose I am traveling abroad to provide training services. I am providing face-to-face training to people abroad. Now that service is also not eligible for. Those are called mode 4 services, and that service is also not eligible for SEIS. What is the reason for mode 1, mode 2 be allowed and mode 3, mode 4 not to be allowed? Reason and the answer is very, very simple and lies in the objective behind the scheme, the motivation behind the scheme. The motivation behind the scheme is infrastructure inefficiencies. In case you are providing service by opening commercial establishment outside India, obviously you are not even facing Indian infrastructure. You are using outside infrastructure. Therefore, you should not be given the reward. In case you are providing services by traveling abroad, then obviously you are using foreign infrastructure, not Indian infrastructure. And therefore, mode 4 services are not allowed for SEIS. Now, unlike MEIS, in SEIS, there is a minimum threshold also for you to be eligible for SEIS. What is the threshold? The threshold is you should have at least exported services of value 10,000 US dollars in the year in respect of which you are claiming the reward. This $10,000 is for individuals and sole proprietorship firms. If you are any other category, the minimum export that you must have done in the year of rendering service, in the year in which you provide for or you apply for SEIS, it should be 15,000 US dollars. Now I'll just pause and take 2 questions of Ms. Gigi Jose. She's from Kerala and she has asked, if I made only one export during the year, whether MEIS is allowable, any limit or minimum amount of minimum invoices? No, ma'am, there are no minimum limits. You are eligible for MEIS. She has also asked, sir, if I satisfy conditions for both duty drawback and MEIS, which should be opted? Both gives credit. Ma'am, there is a little bit of understanding differentiation in this. MEIS is a reward scheme on outwards, irrespective of any duties paid. Irrespective of any duties paid. So, MEIS and duty drawbacks are not mutually exclusive. They are complementary. You can claim MEIS. You can always also claim duty drawback. Both can be claimed. And the reason is very simple. You should not remember this. You should understand this. Understanding will come because duty drawback is a refund of the import duty that you have paid, which you will pay even in case you export goods under MEIS. Whereas MEIS is for infrastructure inefficiencies, not a refund of any duty. So therefore, they are not mutually exclusive, and we have a slide for that wherein we will tell you that duty drawback can be claimed even on goods on which MEIS is claimed. There is no problem. Now we come back to SEIS. And when we come back to SEIS, I want to show you the rate, the actual appendix 3D and 3E of the schedule of the FTP, wherein the rate for SEIS is prescribed. And you can see appendix 3D on your screen. It says serial number, sector, CPC provisional code, Central Product Classification Provisional Code. It is a classification list accepted worldwide for services. So like we have ITC, HS or harmonized system for goods, we have CPC for services. So you have to see as per CPC code 861, if the code is of the services with description legal services will be eligible for 5% SCI scripts, 5% of NFE, net foreign exchange earned up till 30th October 2017. So up till 30th October 2017, the rate was 5%. Then from November 17, the government had increased the rates for SCIS and it went on to 7%. So this is the calculation of SCIS rewards. Now, in addition to Appendix 3E, I was also mentioning in addition to Appendix 3D, I was also mentioning Appendix 3E. What is Appendix 3? Appendix 3 is something to be really concentrate on, really contribute your focus on. Generally, SCIS is eligible on net foreign exchange earned into SCIS rate. That is the calculation of SCIS. So therefore, SCIS is eligible only when goods services are exported out of India and you earn foreign exchange. And how, in what two modes are services exported out of India? Mode 1 and Mode 2. Mode 3 and Mode 4 are not eligible. Mode 1 and Mode 2 is by providing service sitting in India, by providing services to a foreign tourist who has come to India. In these two modes, if services are exported, foreign exchange is earned, you get SCIS. But Appendix 3 is an exception. It says the services listed in Appendix 3, which are services basically in the nature of transport services, if those services are provided to certain agents of foreign company who would, rather than giving you foreign exchange, but would give you INR amount, but that INR amount would be nothing but a replacement of foreign exchange, then in those cases, we will give you SCIS, even when you have not earned foreign exchange. So what are they saying? Actually, they are saying, suppose, I'll take an example, a live example. Suppose there is a shipping line called Emirates, and it is a foreign company. Now, Emirates, if it wants to, foreign company, okay? If it wants to operate in India, it has to open separate company in India with who are nothing but agents of Emirates foreign, who would take orders for Emirates foreign. Emirates is a foreign air cargo airline. Now, in order to take orders from India, it will have a company in India with a similar name like Emirates, and that company will take orders for all the air transport work. Now, this company, when it takes the order on behalf of Emirates foreign company. Now, when it comes to payment, suppose I am GAIL, and I had to export something outside India, for which I booked a foreign service through any freight forwarder. Now, this freight forwarder provided services to GAIL, and rather than receiving foreign exchange, got what? Rather than receiving foreign exchange, got what? Got Indian rupees. Because the agents are located in India, so it is nothing but a foreign exchange saved in India. And because it is foreign exchange saved in India, that is why, sorry, I've taken a wrong example. Sorry. Suppose there is a foreign cargo airline outside India. It has agents in India. Now these agents in India will take services from freight forwarders in India. Why? Because these agents in India or this Emirates foreign company has got orders for air transport of goods. In addition to air transport of goods, it has to undertake various ancillary activities in India also, like cargo handling, like pushing and towing, like maintenance and repair. So all those services are procured by them through freight forwarders. Now these freight forwarders, had these agents not been in India, would have got the money from Emirates foreign company. But because Emirates has agents in India for booking all these orders, instead of paying foreign currency, Emirates will ask its agents in India, which are nothing but subsidiaries of Emirates outside India, subsidiary companies of Emirates outside India, to pay freight forwarders in Indian rupees. Now, government says when agents pay in Indian rupees, actually they should have transferred the money to Emirates foreign, who should have given foreign currency. But rather than doing this, they directly send the money to freight forwarders in India. And that money will be deemed to be foreign exchange, and we shall give you SEIS rewards even on services, this notified list of services, which are basically nothing but services provided to foreign shipping lines and foreign air cargo lines against INR, for which otherwise foreign exchange would have been earned by the freight forwarder, by the person who has provided the services in India. But because agent companies are there in India, they have got INR. So on those services, by way of Appendix 3, it is provided that SEIS rewards will be given. So it is an exception to the general rule of earning foreign exchange. Now we have to understand what is net foreign exchange. Net foreign exchange is gross foreign exchange that you have earned during the year for the services provided by you, for the notified services provided by you, less the expenses in foreign currency incurred by you. The balance of both of these will be net foreign exchange. And on this net foreign exchange will you be eligible for SEIS reward rate. Now, what are the various ineligible categories under SEIS reward rates or SEIS scheme? Suppose you have got foreign currency on account of equity or debt participation, not on account of any service. Obviously, it is not a SEIS rewards eligible amount. Suppose somebody has got foreign exchange because he is employed outside India. That is not for any service. So that person will also not get foreign exchange. SEIS reward. Maybe that foreign exchange is more than $15,000 or $10,000, but still you will not get because it is not for any service. It is for employment. As I told you, if you provide service using mode 3 or mode 4 by establishment outside India or by actually traveling abroad, if you provide any service, you will not be eligible for SEIS. If you receive foreign currency from EFC account, it is called Exchange Earner Foreign Currency Account. It is a type of account. For now, you can remember that if any money has come from EFC account, no SEIS. If you are providing services and you are a EOU, ESTP, STP or BTP unit, same ineligibility was there for MEIS also. So if you are an EOU, ESTP, STP unit, no SEIS. Suppose you are a service provider related to telecom sector, like Airtel, like Vodafone, like Idea, like Reliance Jio. If they are exporting any services, no SEIS. Now, one of the most important condition for you to apply for SEIS is that you should have an import-export code at the time of rendering of service, not at the time of applying, but at the time of rendering of service. This is one condition that you should remember. You should have an IEC at the time when you have rendered services. Now, usage of the reward scripts. The scripts that you have got under SEIS, how can you use them? Same as MEIS, for payment of BCD, for payment of composition fee, application fee, for payment of BCD while clearing goods from private bonded warehouse, public bonded warehouse, same. Whether will you be eligible for drawback? Yes, you will be eligible for drawback. Even when you have paid BCD using the script, you will be eligible for drawback. How do you apply? Same thing. You have to apply to the jurisdictional RA. By what time do you have to apply? You have to apply online within 12 months of the end of the financial year in which services are provided. In MES, it was 12 months of the let export order date. In SEIS, it is 12 months of the end of the financial year. Again, same RA selection. If you are a DTA unit, if you are an SEZ unit, if you are a DTA and SEZ unit, same kind of selection of RA. Again, same thing, that you will be given SEIS with a port of registration, and you can't shift the port of registration from a EDI to a non-EDI port with effect from 10th of April 2019. So SEIS script whenever issued will be as per a port of registration that you may choose, any port of registration. But you can't transfer those scripts from one EDI port to a non-EDI port with effect from 10th April 2019. Split scripts, again that split of 5 lakh rupees minimum. Same is applicable here also. Late cut, same late cut. If 6 months, first 6 months 2% late cut, then 5% late cut, then 10% late cut. SEIS will be time barred after 3 years as in the case of MEIS. Time barred after 3 years. Supplementary claims not allowed under MEIS, not allowed under SEIS. No supplementary claims allowed. So suppose you are applying for the year 2017-18 and you could not apply for certain invoices because you will get only for invoices for which you have earned the foreign exchange. You have received the foreign exchange. Because net foreign exchange earned is actual receipts of foreign exchange minus actual expenses that you make, that you have already paid also. So receipt minus payment. So suppose when you are applying for a year, you have not received in respect of certain export invoices for services, you can't apply thereafter after filing an application because there are no supplementary claims allowed. So if I have applied once for 2017-18, I can't apply a supplementary claim again for 2017-18. That's the law. Now we will break for 5 to 7 minutes, and exactly at 7:45 we'll come back and resume our session with pre-export schemes, which is advance authorization and DFIA. Now we are moving on to another scheme, another chapter of FTP. So we are done with the chapter 3 of FTP. We are only left with status holders. We will take it up later on. We are now moving on to the chapter 4, which is for duty remission and duty exemption schemes. And the first scheme under duty exemption is the scheme of advance authorization. The word itself says advance authorization, and an authorization that you take from the FTP department, from the DGFT department in advance. Means before export, rather before import for goods to be exported. What is it? Let us understand this. Now, as we all know, that duty exemption and remission scheme are two different schemes, part of the same chapter, chapter 4. In duty exemption, you have two schemes, advance authorization and DFIA, duty free import authorization scheme, which will exempt the taxes or duties on import of goods, which goods are to be used in manufacture and then exported outside India. Whereas duty remission schemes are schemes wherein inputs are imported on payment of duty and then exported, and thereafter the duty paid is given as refund, which is two schemes, either duty drawback or refund of taxes paid on export, refund of refund of taxes paid on export with payment of tax. Section 16, option 2. So we are now discussing advance authorization, which is a part of duty exemption scheme. So what is the objective of this scheme? The objective of the scheme is fairly simple. The objective is to enable duty-free import of inputs for export production. So this basically applies on manufacturers who wants to import goods which are leviable to customs duties and use those goods to manufacture a resultant product, and that resulted product is ultimately exported. Same was the motive or the scheme for drawback under section 74. Under drawback also you used to import certain goods, use them for manufacture and then export, on which you used to get a duty drawback. Now instead of taking that duty remission scheme, you are taking for duty exemption. That is, at the time of import itself you will not pay duties, which automatically means that duty drawback and advance authorization are mutually exclusive. Either you can take refund on outward taxes or refund on or exemption on inward taxes. You can't take both. So by way of logic, simple logic, a duty drawback and advance authorization or duty drawback and DFIA are mutually exclusive, but there is some overlapping that we will discuss. They are, as a thumb rule, they are mutually exclusive, but there is some overlapping also that we will discuss. Now, what is the eligibility? Eligibility is to a manufacturer. It is also eligible to supporting manufacturers. So we will for now ignore supporting manufacturers, another category. Basically, it is manufacturer. Now, what all types of exports are eligible for advance authorization? Normal physical export is eligible. Even supplies to SEZ is eligible, which was not there in the case of MEIS and SEIS. Which was not there in the case of MEIS and SEIS, but it is there here. Which was there in the case of section 75 drawback, but which was not there in the case of section 74 drawback. Because this is akin to section 75, it is there here. But export to SEZ are eligible only if they are provided on payment or so whenever exports are made to an SEZ unit or supplies are made to an SEZ unit under advance authorization, you receive money from foreign currency account of the SEZ unit. The SEZ units are allowed to maintain a foreign currency account. If the domestic manufacturer receives money from that foreign currency account, then that type of supply to SEZ will be eligible for advance authorization. Exports to or supplies to SEZ developers or co-developers, even when if you receive INR, is allowed. Supplies to export-oriented undertakings is allowed. So deemed export type of things are allowed. Supply against EPCG authorization, supply to an EPCG authorization holder, that is also allowed. Supply of stores on board a foreign going vessel or aircraft, that is also allowed. So for all these types of exports or similar supplies, you can avail for an advance authorization. That is an authorization from DGFT department which allows you to import inputs without duty, use those inputs to manufacture something, and then send that manufactured item to SEZ, to developers, SEZ developers, to EOUs, to anybody who is a EPCG holder, to a foreign going vessel or aircraft, which goods usually used as stores on board. So this foreign going vessel, on this, if you are supplying an item which is manufactured by you, which will be used as consumable or stores on that item, on that ship or foreign going aircraft, that is also eligible for advance authorization. What all can be imported duty free? So when you apply for a for an advance authorization, what all can you import? You can import against that authorization inputs which are physically incorporated into the export product and taking into account some normal wastage. Fuel oil, catalyst, other which are consumed or utilized in the process of production of export product. Mandatory spares which are required to be exported along with the resultant export product up to 10% of the CF value of the authorization. So understand this. When you go to the DGFT department, you say, I am manufacturing X product for which I need Y, Z, W, and S product. You give me authorization for all these products to be imported duty free. And I promise that I will use these products to make X and send this X product to the list of exports that we have just discussed. That is normal export, SZ export, EOU export, to a foreign going vessel export, these kind of exports. So your authorization can be for what type of goods? There can be Y goods, which are actually physically incorporated while making X. There can be Z goods, which is nothing but a fuel for making X. There can be W good, which is nothing but spares to be given along with X. So suppose there is a printer that is exported, you give a separate ink cartridge, spares to be given. That also is allowed to be imported under advance authorization. Now, if you take this authorization, they say you can import duty free. Now, the question comes, duty free means what? What all duties will be free when I will import against this? When I will import against this advance authorization. So, suppose I'm a manufacturer, I go to the DGFT department, apply for advance authorization. They give me authorization for X product to be exported, for which I can procure X, Y, Z, and W product. And the authorization will mention the HSN of the product, the quantity also, and the value also. How much can I import? That authorization will mention that this much I can import, and with this much import, I will have to make a HSN of this much quantity. This will be the format of the authorization. Now the question comes against this authorization. When I will import, I am importing duty free. What all duties do I have to not pay? I don't have to pay BCD. I don't have to pay social welfare surcharge. Ignore this because it is no more there now, only for few goods. I don't have to pay IGST also. I don't have to pay compensation cess also. This is very, very, very relevant, and we will understand why it is relevant. It has relation to your refund chapter. I don't have to pay any anti-dumping duty if applicable, any countervailing duty if applicable, any safeguard duty, any if applicable. So all these duties will be exempted and I will get the inputs into the country without payment of any of these duty. Just show the advance authorization and now use these goods to produce a resultant product which is to be exported or given to a SZ unit or given to UU unit or given to a foreign going vessel. Now what is the condition for getting this advance authorization? The condition for getting the advance authorization is that I should make a minimum value addition of 15%. Meaning thereby, suppose I realize from my export rupees 100. If I export X, I realize 100. And whatever I imported under the authorization is for rupees 60. Then 40 divided by 60 should be more than 15%. That is, I should at least add more than 15% on my cost of goods sold. And cost of goods sold is the goods that I have imported duty free. And then they say plus any value of inputs on which drawback is claimed. Now this is what is to be understood. I told you in the beginning that these are mutually exclusive. Somebody who is availing advance authorization cannot avail duty drawback. But that statement was not perfectly correct. The thing is that if you are availing advance authorization scheme, you can't avail duty drawback. Yes. Why? Because if you are availing advance authorization on the inputs, you are not paying duty at all. So therefore, there is no question of a duty drawback, because duty drawback is a neutralization of the duties paid on inputs. But advance authorization is based on SION norms, standard input output norms. I'll show you a standard. This is the series SION norm. So they say for DC micromotor, export item, import item. This is a screenshot of a SION norm. Against an export item DC micromotors, all these are eligible for import, or all these are standardized inputs. Now it is not that only these inputs will be used, there will be other inputs also. So the law provides that though drawback and advance authorization are mutually exclusive, but since advance authorization is only eligible for certain inputs which are mentioned in the SION, and there may be some other inputs also, in which case the person who is importing goods under advance authorization can apply for a drawback rate in respect of inputs which are not eligible for advance authorization, which are not given in SION norms. Did you understand? So therefore, if you are exporting X for which you need Y, Z, W, and S. Now these three are mentioned in SION, but this is not mentioned. So you will not be able to import this without duty-free S. So therefore, for S, you can claim a duty drawback. How will you claim a duty drawback for S? We know this. Duty drawback, not the all industry rate under section 75, but the brand rate under rule 4, under rule 6 or rule 7. Because all industry rate applies only when all your inputs are imported with payment of taxes. But since there are only 2-3 inputs that you are not importing with payment of taxes, you have to apply for a brand rate. So, sum and substance, there can be a situation wherein a person has availed for advance authorization and has also availed for drawback in respect of certain inputs not covered under advance authorization. And in which case, this thing will work out. This thing will apply. What is this thing? CIF value of inputs covered by authorization. So, while calculating sale price minus COGS, you have to not just take advance authorization goods plus also DBK goods. And then apply COGS and into 100. Did we all understand this? This is very, very critical and you may get a numerical on this. A minus B divided by B into 100. Selling price minus purchase price divided by purchase price into 100. Minimum 15% value addition. The only catch is that the purchase price shall include advance authorization goods as well as goods on which DBK is claimed. Brand rate DBK is claimed. Suppose if certain goods are supplied free of cost by the foreign buyer, then you add that FOC material here also and here also. Then you will say, if you add something in numerator also, denominator also, what is the difference? Sir, mathematics, there will be a different ratio that will come out. Numerator and denominator, if you add the same amount, the ratio changes. Now, what is the time limit for making import of these inputs? Once you apply for an advance authorization and you get this authorization, within 12 months of this procurement of this authorization from DGFT department, you have to import the inputs. What is the time limit for completing your export obligation? The time limit for completing the export obligation, that is achieving 15% value addition and exporting the goods is, so suppose if you have imported goods worth rupees 1,50,000, then the time limit to reach 1,50,000 plus 15% of 1,50,000 is 18 months. From what date? From the date of issue of authorization. So you get 6 months more. It may be a case that you went to the department and got an advance authorization. After getting the advance authorization, you started exporting without even importing. The legislature or the law is not concerned about that. The law is saying you should be exporting with 15% valuation of the imports that are authorized to you. However, this condition or this situation will not apply in case the import of goods is with a pre-import actual user condition. Is with a pre-import condition. What is the pre-import condition? Suppose the CON norm, now CON norm is, now advance authorization is the scheme which uses CON norm. We will understand this further. So suppose the CON norm says for X product sold and exported, you need 10 products. Out of these 10 products, 2 products are subject to pre-import condition. Now you have to import these goods first for them to be incorporated in the product and then export. Then only will you qualify for fulfillment of export obligation. If the goods are not eligible or not applicable to pre-import condition, then no problem. You can export even without importing. The legislature is not concerned with that. Only if the goods are not applicable to pre-import condition. Now they say for fulfillment of export obligation, the money should be received in foreign currency. However, in respect of exports to SEZ, money may be received in foreign currency from the foreign currency account of SEZ. And in case of exports to co-developers and SEZ developers, money may be received even in INR, and we shall consider that in the case for calculating value addition. What is the form for applying for advance authorization? Advance authorization obviously has to be applied before you start the import and the export process. It is to be applied in Form ANF 4A. So you go and file an application in ANF 4A before the DGFT and say what? That I want to export goods X of quantity 100, for which as per CON norms I would need Y, Z and W of quantity 30, 20 and 50 of HSN so and so, and this HSN will be so and so, and please grant me advance authorization. DGFT will see the CON norms, see if your application is correct, satisfy for all other conditions and grant you this authorization. It's a complete online process with minimal liaising with the department. Now, as I am repeatedly telling you that advance authorization is the scheme which uses CON norms. Now let us see what are all the modes in addition to CON norms for application of advance authorization. One second, my video is freeze. I'll just take care of that. So basically there are 3 to 4 modes of application for advance authorization. The first one is based on CON. What do you do? Where you apply for advance authorization before the DGFT department and say that see my product is covered under CON norms. So if you will open the CON norms, these norms, and you will go to a chapter, my product is covered in this chapter in export item, and against that export item there are goods mentioned in import which are used for its use as its input based on that same CON norm. So if CON norm says for producing product X in quantity 1, you need 0.2 quantity of this, 3 quantity of this, 4 quantity of that. I want the same quantity ratio. You grant me authorization. They will grant you authorization. So this is advance authorization based on CON. For example, which I have already shown you. So if I agree with this authorization, with this input-output ratio, I will go with CON and apply for it. And I will usually get it in a bit fast manner because obviously I am agreeing with the CON norm. Now suppose my product is a product in which for which there is no CON notified. So when I go to CON schedule, I do not find my export product. Then what do I do? Maybe my product is there, but my inputs that I am actually using is different from the general category input in CON norms. Then what will I do? Because that general category inputs, if I apply for, I will not be importing. And if I will not be importing, that advance authorization is of no good use to me. So therefore, in that case, I can take the complete backing of my input ratio, my different inputs, and apply for a ad hoc norm before the DGFT department and say, see, my product is either not there or my product is there, but my inputs are different in a different ratio or maybe a different inputs altogether. And therefore, based on which I do not satisfy or CON norms do not fit me at all. And therefore, you give me a separate input output ratio, a separate ad hoc norm. That these are called ad hoc norms. The word is itself self-explanatory. Ad hoc norms based on the manufacturing process and input output ratio given by me. Now the only thing is when you apply for ad hoc norm, so suppose I got an order for an export product and I had to export this mouse. Okay. Now when I saw the CON, in the CON there was no mention of this export product. In the CON, there was no mention of this export product. Then what did I do? I went to the DGFT and say, see, this mouse is not there in the CON. This is my manufacturing process. These are the inputs that I will use. Please grant me authorization. Maybe it was mentioned, but they said you have to use plastic, but I was using carbon fiber plastic. So I wanted a different CON. So they gave me, I applied for an ad hoc norm. The only thing is ad hoc norm is applicable only for the order that I have applied for. So suppose I applied for 100 mouses once. After I manufacture 100 mouses, I again have to apply for ad hoc norm. I again have to apply for ad hoc norm or advance authorization based on ad hoc norms. Or I can apply before the norms committee and ask them or plead them that allow me for repeat advance authorization based on the same ad hoc norms. I can do that also. Then there is a third process. The third process is the process of self-declaration. Suppose there is a case wherein I have got an export order and I have to fulfill that order within one week. Now I can't wait for applying for an authorization and then getting it and then importing and exporting. No. What do? I apply for an advance authorization based on self-declaration. Why? Because my product is a product where CON norms are not there and ad hoc norms are also not there. Or I want to use a different input output ratio or a different input. Now I can't wait for the norms committee under DGFT to fix a norm and then apply and then get an advance authorization and then export. So they say without waiting for an ad hoc norm, you rather go for an ad hoc norm on self-declaration basis. So you say whatever I have declared should be taken as correct and I should be given the declaration without even fixation of the ad hoc norm. Now the only difference between ad hoc norm and self-declaration is that in ad hoc norm, norms committee sits, decides the norms and then an advance authorization is given. There is a time lag. Whereas in self-declaration, you don't wait for, or the DGFT does not wait for the norms committee to sit and decide. They give you the advance authorization. Thereafter, whenever norms committee decides the norms, if it is higher, you get a higher advance authorization. If it is lower, you have to pay the balance duty that you have saved at the time of import. So that is advance authorization on self-declaration, which is nothing but a quicker process of getting ad hoc norms. This also is applicable in case where CON is not there or ad hoc norms also not there, and or you may want to have a different input output ratio. Then the fourth one is self-ratification. Self-ratification means it is a case where CON and ad hoc are not available, obviously, or I have a different input output ratio, and I am a person who has a AEO certificate, Authorized Economic Operator certificate. That is, I am a renowned exporter. I am a credible exporter. and I have applied for that status and I've got this status. The status called AEO certificate holder. So you have to apply for this status and show that how you are a credible exporter, or what are your internal controls and all those things. And I've got that status. Based on that, I don't have to apply for ad hoc norms or advance authorization based on self-declaration. Rather, I file an application with a chartered engineer certificate. See, there is a certificate of the chartered engineer, certified chartered engineer, who says that these inputs will be used for making this product, and you have to agree with this because I am a AEO certified exporter, a credible exporter, and there is no requirement for norms committee to ratify what I have declared, and whatever I have declared, based on that, advance authorization will be granted to me with no further ratification by the norms committee. The only thing is, you will be allowed for self-ratification only if you are a credible exporter, only if you are a AEO certified exporter. So this is the fourth manner in which you can apply for advance authorization. Now the fifth one is annual advance authorization. Who shall be eligible for annual advance authorization? Exporters having performance shall be entitled for advance authorization for annual requirement. Generally, what you get as an advance authorization is export order wise. Suppose you have got an order for 100 mouse, you take an advance authorization. Then you got an order for another 50 mouse, then you take an advance authorization. Then another 500 mouse, you take an advance authorization. But you can also, as an alternative, avail advance authorization as an annual requirement. If this is my annual requirement, you grant me once advance authorization. But that shall be given to you only if you are a high value exporter. You have a performance exporter in the last two preceding financial years. What is the upper limit for annual requirement advance authorization? The upper limit in terms of CIF value of imports, not import duties, but imports, shall be 1 crore or 300% of the FOB value of physical export, whichever is higher. 300% of the exports that you have done in the preceding financial year, or 1 crore rupees, whichever is higher, is the upper limit for annual advance authorization. So up to 1 crore or 300% of the FOB value of the exports that you have made in the last year will be the upper limit for your import CIF value under advance authorization. Again, advance authorization for annual requirement will be issued only where there is a CON, or a valid ad hoc norm. If you do not have a CN or a valid ad hoc norm, you will not get an annual requirement advance authorization. So you can't go for a self-ratification plus annual requirement advance authorization. No, you should have a CON or a ad hoc norm for you to apply an annual requirement advance authorization. Now, up till now, what we have discussed is only import and export in terms of advance authorization. Against the advance authorization that you receive from DGFT, you are also eligible to procure goods domestically. How? What you have to do is you have to take your advance authorization to the DGFT department and get an advance release order or an invalidation letter. And now with this invalidation letter, a copy of that is given to a domestic manufacturer or a domestic person who can send these goods, who can supply goods to you against advance authorization. Now you have to link this. What is this? Section 147 of the CGST Act is what you have to refer to. Section 147 provided what? If you supply goods to a person who is an advance authorization holder or a EPCG holder or a EOU, then whatever taxes you pay on those goods will be refunded to you or the buyer, that is EOU or advance authorization holder or a EPCG holder. This is that same thing. They are saying, suppose I am an exporter of mouse and I import plastic, mouse wheel, buttons, battery from outside India to manufacture the mouse and then I export. Rather than importing, I can also procure these goods domestically against advance authorization. What do I have to do? I have to go to the DGFT department and say, please issue me an advance release order against this advance authorization. They will give me some copies. One copy will be given to the domestic person who will supply these goods to me. And once he supply these goods to me against advance authorization, advance release order, either him or me would be eligible for refund of all the taxes that are applicable on the goods supplied to me domestically. So effectively, there will be no taxes on the goods supplied to me domestically. Why would someone not procure from import but procure from domestically and procure against advance authorization? Because if you would have procured domestically, you could have paid IGST and claim credit and taken refund also, because you are exporting ultimately. But why would you do that? Maybe because you are a petroleum company. Maybe because you are a company which already has a lot of excess credit. So suppose you are a petroleum company, whatever taxes you pay domestically will not be eligible as credit to you because you are non-GST supplier of goods. Maybe you are a tobacco company. In that case, what will you do? Even when at the time of domestic procurement, you take use of your advance authorization and procure goods without payment of taxes. That is the relevance. Otherwise, a normal manufacturer who is not supplying or who is supplying goods which are liable to GST, why will he claim or why will he waste his advance authorization on domestic goods and not on import goods? He will do that only when he has a scenario wherein he is not eligible for credit on those domestically procured goods. And therefore, he will use his advance authorization so that IGST payable on those goods is refunded back to him when he procures them domestically. Also, because if you are an advance authorization holder, remember this, you are not allowed option 2 of section 16. Option 2 of section 16. What was that option? Export with payment of tax and refund thereof. So if suppose I'm an AA holder and I import most of my inputs without duty against advance authorization, and I procure some of my inputs domestically without using my authorization, so I have to pay IGST. I take credit of this IGST. Now I can't use this credit to make payment on export and claim automatic refund. I will have to definitely apply for refund of unutilized ITC, which is a cumbersome process. So I don't want to go for that process. That is why I will use my advance authorization even for domestic supplies. Now another condition for advance authorization is actual user condition. It provides that inputs imported shall be subject to pre-import condition and they shall be physically incorporated in the export product. In case of local procurement under advance release order, input shall be procured prior to manufacture of export item and shall be physically incorporated in the export product. So there is an actual user condition for advance authorization. If you have procured certain inputs under advance authorization duty free, they have to necessarily be incorporated with the export product. You can't sell them off. Imported or domestically procured inputs against advance authorization cannot be sold or transferred to anyone. Even when you have completed your export obligation, no, you can't do it. However, if you have used the inputs to manufacture something and after you have completed your export obligation, suppose you imported 100 units and out of which you made 200 units, but your export obligation was completed after selling 150 units only, and you are left with 50 units, these 50 units can be sold off in the domestic market because you have already completed 15% value addition with this 150 units only. But this 100 units cannot be sold off even when you have completed your export obligation. But waste and scrap arising out of the manufacturing process can be disposed of on payment of applicable duty even before fulfilling of export obligation. So they say waste is normal, you can dispose it off even when you have not completed your export obligation. Drawback, I have told you already. Although drawback and advance authorization are mutually exclusive, but for inputs which are used for advance authorization or which were procured under advance authorization, on inputs which cannot be procured under advance authorization because they were not part of SION, you can still claim drawback, but you can't claim AIR drawback. You can't claim AIR drawback. No. You can claim only brand rate drawback for those specific inputs. You apply for the specific inputs drawback and you can claim that drawback. Now, every time we read a scheme, we will link it with that option 2 of refund, export with payment of tax. MEIS, SEIS had no linking with option 2. Even when you claim MEIS, SEIS reward, you can always go for option 2. But if you are going for advance authorization, export with payment of tax is not available to advance authorization holder. An advance authorization holder cannot take that second option of section 16 of the IGST Act. Now we go to the second scheme, and the second scheme under duty exemption scheme is the scheme of duty-free import authorization. This is nothing but advance authorization post facto basis. Let us understand this, and we will not devote a lot of time on this because we have to take 2-3 more schemes and we are left with only 40 odd minutes. I will tell you the basic concept behind this scheme. The basic concept is under advance authorization, you used to procure a advance authorization certificate. Use that certificate to import inputs without duty. Use those inputs to manufacture a product. Sell that product outside India. Complete your 15% value addition. And that was the complete process. It may be a case wherein you do not want to import goods duty free. In such cases, you have an option to apply for DFIA. What is this scheme? This scheme says that before applying or before starting to export the goods, suppose I got an order for 500 mouses. I will quickly go to the GSGFT department and say I am applying for DFIA for 400 units of mouses based on a CON which is there for mouse. So for 400 units, I need 400 mouse wheel, 400 buttons, 500 kgs of plastic, this and that. They will give me a DFIA. They will give me a DFIA authorization. What will I do? I will start import, but I will not import with any duty exemptions. I will import after duty payment. Use those imports and export goods. Start exporting goods. After I have imported the goods and manufactured and exported the goods, every time I export, I will mention this DFI license number on my export. Based on the number of mouses that I have export, I will then again go to DGFT and say, see, based on the DFI that you issued me, I imported, or maybe I have not imported, you are not concerned with that. I have exported 400 mouses of the CON that you had mentioned. Now give me duty credit scripts. What did you give me? What do you give me? DFIA certificates or duty credit scripts equivalent to BCD payable on the import of inputs for these 400 mouses. And these will be transferable scripts. So basically what will I get? After I have made the export, using the import or maybe not using the imports. So I may have imported goods, I may not have imported the goods. Legislature is not concerned with that. Legislature is saying that when you exported the goods, you had a DFIA with you. You mentioned the DFIA number also. And you have exported the goods equivalent to the DFIA authorization you took from us. Now you will be given a certificate based on which you can import the same ratio of inputs that would have had been used for manufacture of these mouses without payment of only what? BCD. This time not all duties, but without payment of only BCD. No BCD. Now this certificate that I will get is called DFIA. And this certificate is saleable. So anybody who is manufacturing similar mouses, I can sell it to him. And I can earn revenue. So it is a post-export benefit. Rather, the benefit is pre-import, but it is granted post-export. You don't have to actually import the goods. You can just export using the inputs that you have and get the scripts and sell them off. Or maybe use it again, maybe in your own business. That is the scheme. Let us quickly go through it and move on to the next scheme. Provisions applicable to advance authorization are broadly applicable to DFIA. DFIA is issued to allow duty-free import of inputs. Duty-free import authorization shall be issued on post-export basis for products for which CEON has been notified. So a point to remember is that DFIA is given only for products for which CEON is given. If there is a product for which there is no CEON, no DFIA will be given. DFIA is only when a CEON is given, because once you apply for DFIA, the DGFT department should have a standard input output ratio for you to be allowed a scripts. DFI is allowed only on inputs which do not have an actual user condition. So if you go to CEON, and this is the CEON, some inputs have this note: CEON shall be operated under actual user conditions. If your product has inputs which has actual user condition as a note, you can't take DFIA, because for those products, whatever inputs you import have an actual user condition. Actually, it should be used in the product that is exported for which DFIA or advance authorization is claimed. So if your product has inputs as per CEON which has actual user condition, no DFIA for it. You will get a DFIA for basic custom duty and social welfare surcharge only. IGST and cess will be payable. What all can you import using DFIA? Again, same things. You can import the actual product. If you have sold this DFIA, that person can import the actual product, any oil and catalyst, or any spares. How do you apply for it? You have to apply by way of an application to the regional authority before effecting the export under duty free. So you have to apply before exporting the product. The export shall be completed within 12 months. There it was 18 months. 12 months import, 18 months export. Here it is 12 months. Within 12 months of date of online filing of application and generation of file number, you have to export the promised products. After you have made the export, you make a application for issue of DFIA, which should be made within 12 months of the date of export or 6 months from the date of realization of export proceeds, whichever is later. RA will issue transferable DFIA with a validity of 12 months from the date of issue, 12 months. For MEIS SES, scripts had a validity of 24 months. Here the validity is 12 months. MEIS SES scripts can be used for any goods import. Here the scripts that will be issued, DFIA will be issued, can be used for only those imports which are used in that product. Now for DFIA, your minimum value addition shall be 20%. For advance authorization, minimum value addition was 15%. For DFIA, it should be 20%. So when you export, you have to justify that the CEON norms inputs value and your sale prices, the difference between the two is more than 20%. Drawback shall be available. Why drawback shall be available? Because you have imported inputs without payment of or without taking any exemption. When you have imported inputs for DFIA, you have not claimed any exemption. The person to whom you will sell this DFIA certificate will claim exemption. You will have not, so therefore you will be eligible for proper drawback. If I have to comment on the relationship with option 2 under section 16, if you are a holder of a DFIA, you will be eligible for export with payment of tax, because again you have imported with payment of tax. If I have to mark out the difference between advance authorization and DFIA, advance authorization is not transferable, DFIA is transferable with 15%, 20%, available to gem and jewelry sector, not available to gem and jewelry sector. Actual user condition is there, actual condition user condition inputs are not allowable for DFIA. It is as per It is available as per CON norms, self-declaration, self-ratification, ad hoc, but it is only when CON norms are available, DFI is available. Only BCD is exempt. Only BCD is exempt. IGST is also exempt. Then we come to another scheme which is called the scheme of status holders. Now this is not a very relevant scheme in terms of anything to be explained. It may be relevant for examination purposes, but nothing to be explained as such. The basic criteria under the scheme, if I am to quickly run through it, is that if suppose you have an export performance of 3 million US dollars in the preceding 2 years out of the last 4 financial years. So in the last 4 financial years, out of those last 4 financial years, 2 years you have, at least 2 years you have $3 million export performance, or $25 million export performance, or $100 million export performance, you will be granted a status accordingly. You have to first achieve this performance and apply for this status. After you have applied for this status, you will be eligible for certain benefits. What are the benefits? So this is the process of applying. This status will be valid for 5 years. After every 5 years, you have to apply again and get a renewed status. What is the benefit of this status? Basically, you get a status based on your high export performance of at least $3 million in the 2 financial years, in the last 4 financial years, or amongst the last 4 financial years, and so on. 1-star export house, 2-star export house, 3-star export house. What is the benefit of getting this status? The basic benefit is that you are taken as a credible exporter or importer. Your self-declarations are accepted at the seaport or airport or air cargo complex. You are given various benefits in terms of only a normal bond instead of a bank guarantee. So in many cases, customs requires a bond to be given, but for you it will be many cases customs requires a bank guarantee to be given, but yours will be done through only a bond, a simple bond. You will be also allowed a special priority for fixation of input-output norms. So suppose you are a 1-star, 2-star, 3-star export house and you apply for ad hoc norms. The time limit for your ad hoc norms to be fixed is 60 days, a priority to you. You may also be allowed to establish an export warehouse. What is export warehouse? A warehouse which can be established outside the country and where you can store the goods without having the mandate of receiving the foreign exchange within the FEMA guidelines. Otherwise, if you export goods, you have to get foreign currency within 9 months or 1 year, whatever is the time limit as per FEMA. But if you are an export house, you can establish a foreign export warehouse without getting the mandate or without having the mandate of receiving foreign exchange within the specified time. You shall also be granted benefits as per Accredited Clients Program, ACP program. This is also a program wherein benefits and priority and self-declarations are given, priority is given to these exporters in terms of smooth custom clearance, not a lot of checking, self-declarations are accepted. So basically, you will be taken as a credible exporter and given some benefits. Now we come to chapter 5. We are left with chapter 5, 6 and 7 and very less time. So we'll be a little quick. We come to this scheme called Export Promotion Capital Goods Scheme. What is the scheme? It is nothing but a scheme in as complementary to or in line with advance authorization. Advance authorization allowed you to import inputs duty free to be used for manufacture of goods which are ultimately exported. This allows you to import capital goods duty free which are used for the manufacture or service provision. This is also applicable for service provision. You have to remember this. Advance authorization was not. This is also applicable for service provision. So you can import capital goods duty free for manufacture of goods which is ultimately to be exported or for service provision outside India. What all duties are exempted? Basic custom duty is exempted. Social welfare surcharge, IGST, compensation cess, all of them are exempted if you import capital goods under this scheme. You also have an option to not claim in advance authorization. There was no option. You have to take exemption of all BCD, social welfare surcharge, IGST and cess. And there was no need for an option also, because once you are importing a for export, why would you want to pay IGST and cess? But in case of capital goods, they say you have an option not to pay IGST, not to claim exemption of IGST on import of capital goods and compensation cess, but pay them in cash. And not avail credit thereof. Then they will not be considered. The duty saved on them will not be considered for calculating the export obligation. Actually, for you to understand this clause, you have to first understand that under EPCG, under advance authorization, the export obligation was 15% value addition. Under EPCG, the export obligation is 6 times duty saved. So suppose I imported capital goods of rupees 100 on which BCD was 10, on IGST was 11. 21 is what I have said. I have to make an export of 21 into 6. 126 rupees in the next 6 years. This is the export obligation under the scheme. Now the scheme says, suppose you are in an industry wherein you don't get credit of IGST. And it is difficult for you to manage a 126 rupees export. However, you can manage a 60 rupees export only of BCD. Then you have the option to pay IGST in cash and not take credit. So that is why the option is given, because the export obligation is based on the duty saved. Whereas in that case, export obligation was based on the import value and the export value. You have to apply your mind and understand this by way of an example. So because I may be in an industry wherein I may not be able to achieve the export obligation as per 6 times the duty saved, I have an option to not save few duties and pay them in cash, but I should not be availing credit also of those duties. So who will take this option? People who are not otherwise eligible for credit, or people who otherwise have a lot of credit already lying in balance. What are types of capital goods can be imported? Computer systems, spares, molds and dies, various types of capital goods which are mentioned in this definition, catalyst, and tools, jigs, fixtures, tools, refractories, even capital goods in CKD, SKD conditions. So the list is long and wide. Who can avail this scheme? Manufacturers can avail this scheme. Merchant exporters who have a connected manufacturers can avail this scheme. Service providers can avail this scheme. This is very, very relevant. You can ignore this for now. CSP. So service providers are also eligible for this scheme. So if suppose I am providing service, I am a call center or I am an outsourcing unit, BPO, I am also eligible for this scheme. I can import capital goods in the form of laptops and not pay BCDs, IGST on them and use them for rendering services outside India, EPCG scheme. What are ineligible imports? Tractors, motor cars, airport ground handling equipments, construction materials are some of the items which are ineligible as capital goods import under EPCG scheme. Imported capital goods shall be subject to actual user conditions. So it is not that you can import capital goods one and not use them at all. They are subject to actual user condition. After you import the capital goods duty free under EPCG, you cannot transfer and sell them off until you have completed your export obligation, that is 6 times the duty saved. Same was the case of advance authorization. In advance authorization, you could not have sold your inputs at all. You could have at best sold your finished product, that too after achieving your export obligation. Once you get the authorization, EPCG authorization, you have 18 months to import the capital good. A person who has got an EPCG validation or certificate, he may procure goods from outside the country or may even procure the goods domestically. Same in the case of advance authorization. Section 147, wherein a person can supply goods to a EPCG holder and claim refund of the taxes paid. So it is promotion of domestic procurement. A person can procure capital goods from outside the country, even within the country, and that purchase within the country will also be duty free. How? By way of refund. Section 147. Either the supplier can take refund of the IGST and cess paid on the goods, or the buyer can, the EPCG holder can. How to calculate your export obligation under EPCG? Export obligation is duty saved amount, BCD, social welfare surcharge, IGST, cess into 6 times. That is your export obligation. That is the value of export. Remember this. This is the value of export. Duty saved. All right. 6 times of duty saved is the export value that you have to achieve. In case you are sourcing capital goods not from outside the country but within India, then your export obligation is 75% less. So 6 times into 75%. How much? So 6 into 3 by 4. That is 18 by 4. That is 4.5 times. So if you are indigenously procuring capital goods, you will be eligible for, or you will have to only satisfy 4.5 times the duty saved, promoting domestic procurements. How do you satisfy this export obligation? And what is the concept of average export obligation? So in addition to specific export obligations, the 6 times of duty saved is specific export obligation. You also have to satisfy average export obligation. What is it? It says in the preceding 3 financial years in which you have got the license, if you were already making exports of similar products, the average of those exports you made in the preceding 3 financial years should be maintained in the complete export obligation period. So you have to achieve specific EO of 6 times of duty saved. This has to be achieved in 6 years. Correct? Now, in these 6 years, you also have to maintain average obligation. What is average obligation? Suppose you had got an EPCG for manufacture of mouse. And this mouse, you were already manufacturing before import of this capital goods. So you were expanding your capacity. Before import of this capital goods, for additional capacity of mouse, you were already exporting mouse, suppose at an average of 100 units per year. So when you are calculating this 6 times of duty saved, only those goods will be calculated or taken into consideration which are over and above 100 units. So you have to maintain that average of 3 years, preceding 3 years throughout the 6 years and achieve specific EO. Achieve additional EO. Suppose additional EO is 20 units more. So you have to achieve 120, not 120, 100 each year for the next 6 years. And 20 additional in total in the next 6 years. That is the combination. You have to achieve average plus specific EO, both. Suppose, okay, not suppose. In this limit of 6 years also, there is a limit that in the up till 4th year, you should have achieved at least 50% of your specific EO. So it should not be that you achieve the complete specific EO in the last 6th year or 5th year. At least 50% should be achieved in the first 4 block of years. Suppose you fulfill 75%, that is 4.5 times, or 4.5 times ka bhi 75% within only first 4 block of years. Suppose you were to achieve 100 units in 6 years, but you achieved 75%, 75 units in the first 4. They say you will be condoned with the balance export obligation that you had to achieve, provided you achieve 75% in the first 4 financial years. We are talking about specific EO. Average EO in all the cases will have to be maintained at the same level, be it 4 years, be it 6 years. Now, what all types of exports will be counted for calculating EO? Exports which are normal physical exports. Exports to EOU, STP, EHTP, BTP, SEZ shall be counted towards fulfillment of export obligation along with usual benefits available under deemed export. We will refer to deemed exports in the next one. Exports of ITA1 goods. Sorry, not export. Supply of ITA1 goods to DTA. What are ITA? Information Technology Agreement. There is an agreement signed by India with other countries wherein they have realized, they have analyzed, or they have recognized certain goods to be technology goods. And those goods, even when supplied to a DTA against free foreign exchange, even when supplied to somebody in DTA against free foreign exchange, will be counted for EO. Will be counted for EO. Very, very important point. How will they monitor that you have achieved the export obligation? They will monitor you have achieved the export obligation by making you submit a return by the 30th April of each year with the RA concerned. We can skip this. These are additional, were not there in the Board of Studies material. I have just included out of my own experience and knowledge. You can refer to them thereafter. So this is EPCG scheme, wherein you are allowed to import capital goods duty free, use them for actual manufacture of goods or provision of services, and earn foreign exchange. This foreign exchange should be 6 times of the duty that you saved on the capital goods imported. In case you have imported capital goods indigenously, it should be 4.5 times. It should be achieved within 6 years of the capital goods import. And thereafter, if you achieve 75% of the obligation within the first 4 block of years, rest is condoned. And you have to necessarily achieve specific EO of 50% of the export obligation, specific EO within the first 4 years. And in all these years of 6 years, you have to maintain an average obligation, which is average export of the same or similar products in the preceding financial year. Now, what is post-export EPCG, which is much like DFIA in case of EPCG, wherein a person is granted duty credit scrips for payment of BCD once he has exported certain goods. So rather than importing capital goods duty free and using them for manufacture or rendering of services, what you can do is you can apply for a post-export EPCG. You can first import capital goods on full payment of duty, manufacture goods, export them, or provide services. And thereafter, you can apply for a post-export duty credit scrips. These duty credit scrips will be given to you for payment of BCD. These duty credit scrips again will be completely transferable. What will be the value of duty credit scrips? BCD payable on the goods that you have imported. So suppose you imported a capital good, provided services export or manufactured goods and exported them. Whatever duty that you have paid on the imported capital goods, BCD only, Of that amount, you will be given a post-export EPCG, which is like a duty credit script, which is transferable, which can be sold off to any other party. Now, what is the benefit? The benefit is that you can apply for it post-export. You may have not availed the complete EPCG, or you have not applied for the complete EPCG authorization and went through the procedure of importing without payment of duty. You can do this also. This is the process of how to apply for post-export EPCG. Basically, the thing is, rather than importing duty-free, you import duty with duty, manufacture or provide services, then apply for a duty-free, post-export EPCG. They give you a duty credit script equivalent to the BCD that was payable on the import, that was paid on the import of capital goods. Everything else remains the same, obligation and 6 times and everything remains the same. Now we move on to chapter 6 and chapter 7. They are fairly simpler. And then the schemes that we have discussed. We have discussed up till now schemes of MEIS, SEIS, Advance Authorization, DFIA, EPCG and post-export EPCG. One thing I left in EPCG, that if you are a EPCG holder, whether will you be eligible for option 2? Yes, latest amendment. You will be eligible for option 2, export with payment of tax. You will be eligible. Now we come to status holder schemes, EOU, ESTP, STP, BTP. What are they? I'll tell you very simply, in a very simple fashion, what are they? There is a board called Board of Approval. Rather, I'll start with this. The schemes are, or the status is EOU, then Electronic Hardware Technology Park, then Software Technology Park, and Biotechnology Park. Now, all these are more or less the same. Just that EOU comes under Ministry of Commerce and Industry. Whereas STP, ESTP, BTP comes under, so this one comes under Ministry of Information Technology. And BTP comes under Department of Biotechnology. So administration department is different. Otherwise, they are same. What are they? Suppose you make a minimum investment for manufacturing goods, which are electronic hardware, or for developing software which are to be exported, or for some biotechnology products, or for some other type of goods to be manufactured in India or services to be provided from India, you can apply for a EOU, ESTP, BTP unit in the concerned ministry. In the concerned ministry, Board of Approval is the board which will grant you this status. Now the point to be remembered is that such units can be set up only for manufacture of goods, repair, remaking, reconditioning, re-engineering, rendering of services, development of software and agriculture. They cannot be for trading. They cannot be for trading. You cannot have a EOU unit or ESTP or STP or BTP unit just for trading. If you are merely a trading concern, you can't have this status. So you apply with the Board of Approval with the necessary conditions to be satisfied and you get this status. Basically, these units are units which are primarily oriented towards exports. So these units primarily are engaged in exports of goods manufactured in India or export of services provided from India. What is the obligation for these units to have the status? The obligation is that they should have a positive net foreign exchange. That is, their expenses in foreign exchange should be lesser than the income in foreign exchange. That is all is the condition. What is the benefit of having this status? The benefit of having this status is that you can import capital goods and inputs without payment of BCD, CGS, IGST and cess. That is the benefit of having this status. Up till what time do you have to maintain this positive net foreign exchange? In the 5 years. So this NFE is not checked every year. This is checked in a block of 5 years. So for every block of 5 years, you have to maintain a positive NFE for you to be eligible EOU, ESTP, STP and BTP unit. So you initially apply to the Board of Approval. They give you a status. based on the conditions satisfied by you. Now you have to make sure that you apply. Once you have applied, you maintain positive NFE in a block of 5 years. If you don't, whatever benefits that you have taken in terms of income tax benefits or in terms of indirect tax benefits, that is import of capital goods or inputs without payment of taxes, or procurement of goods under section 147, again deemed export, from domestic manufacturers without payment of taxes or by taking refund of taxes, both will have to be given back along with penalties. What all supplies will be counted towards positive NFE? So what will be considered as foreign exchange earned? There are various supplies. You can refer to them and understand what all supplies will be covered. One of the important ones are ITA supplies. ITA supplies even to a DTA unit for export will be considered to be a positive foreign exchange. So we have discussed this. What are the entitlements? Entitlements are import of goods exempt from basic customs duty and IGST. Now this has been extended to 2021. So read it like that. Now, in addition to import and indigenous procurement of inputs and capital goods and then further export by these units are also allowed to sell off a part of their product manufacture into DTA, transfer a part of them to another UU BTP, or procure, So they are allowed for domestic sale also, but that domestic sale or transfer of goods to another UU is subject to certain conditions and limitations which is prescribed in these slides. So these slides will tell you what is the limitation for these units to sell goods to DTA. It is not that they can import capital goods and inputs without duty and sell them off freely. The condition is that when you import, the basic concept is that these units are allowed import and indigenous procurement without payment of taxes or refund of taxes on the condition that they will export. But it is not that they can just export. They can also supply goods or services within DTA. But that is up to a certain limit. Those limits are mentioned here. I'm not referring to the numbers. Those limits are mentioned here. And in case you go beyond those limits, and even in those limits, what you have to do, you have to make sure that whatever exemptions that you claimed at the time of inward are refunded back, are compromised when you are supplying to DTA. So suppose I imported from outside India without payment of BCDs, social welfare surcharge and IGST and cess. Now I want to clear these goods to DTA because they are no more of use to me. I have to refund back, pay back the BCD exemption, IGST exemption, cess exemption. Then only can I clear. That too within the permissible limits. So that is what has been prescribed in the slides that are there on the screen. So different type of limitations and duty foregone, duty to be paid is there in respect of byproducts, in respect of rejects, in respect of waste products, in respect of normal supplies to DTA. So those things are mentioned in the slides. Now suppose you want to exit from this EU status. You got an EU status, you procured goods, you maintained NFE. Now you see that you will not be able to maintain NFE. How can you exit from this status? You can again apply to the Board of Approval, BOA, and say, I want to exit. They will come to your premises and see what all inputs are lying on which you have taken export benefits. No CGST, no IGST, no BCD. Pay them back that amount along with interest. They will say what all capital goods are lying on which you have claimed this exemption. Apply a depreciation rate and ask you for the duty that you have saved, and then will allow you to relieve from the status of a export-oriented undertaking. So basically, these are just statuses granted to you, which will allow you to have specific exemption in terms of indigenous procurement of goods and import procurements of goods as well as services in terms of duty-free imports and duty-free indigenous procurement. That is all. And in case you want to divert from this scheme, only a limited diversion in terms of DTA supplies is allowed, that too based on certain conditions. So that is the complete scheme of EOU, which have 2-3 genres, that is export oriented undertakings such as general units. Then you have EHTP, Electronic Hardware Technology Park, Software Technology Park, Biotechnology. Now we come to the last topic, and the last topic is on deemed exports. What are deemed exports? This is chapter 7 of the foreign trade policy. What is the objective behind this chapter? The objective of deemed export is to ensure that the domestic suppliers are not in a disadvantageous position vis-a-vis foreign suppliers in terms of the fiscal concessions. So they are saying it should not be so that a person who is sitting outside India, if he sells goods to a person in India, his goods are more favored because against an advance authorization or an EPCG, you can procure inwards from outside the country without payment of duty. But such is not the case if you procure inwards from within the country. So your domestic suppliers supplying to the special categories buyers, that is EU status holders, EHTP, BTPs, or advance authorization holders or EPCG holders, should not be worse off than the foreign suppliers supplying to these units. So even when a domestic supplier supplies to these export-oriented type of undertakings, which may be the SEZ, which may be EOU, EHTP, BTP, AA holder, and EPCG holder, should not be worse off than the foreign suppliers. And that is why we will give the same benefits as are applicable to a foreign supplier who is supplying them goods as in terms of import when a domestic supplier supplies these goods to a person in India, provided that the domestic supplier is supplying goods which are manufactured in India. Then this scheme will apply. So they are to bring at par foreign suppliers and domestic suppliers. What all types of supplies are covered under deemed export? Supply of goods against advance authorization, 147. Again. Supply of goods against DFIA, 147. Again. Supply of goods to EOU, STP, BTP. So suppose I am a DTA supplier supplying goods to an advance authorization holder, to a EOU holder, to a EO status holder, to a EPCG holder. My goods will be taken as deemed export. And what will be the benefit? The benefit will be that I will be eligible for drawback. I will be eligible for drawback like a proper exporter. I will be eligible for refund of taxes on my outward because I am supplying to a person who will ultimately export. So we will look at the benefits of becoming a deemed exporter. What are the benefits? Advance authorization for annual requirement, DFIA, deemed export drawback. So suppose I am a deemed exporter, that is I am supplying to a person who is a holder of advance authorization, who is a holder of EPCG authorization. I can myself also avail advance authorization. Please understand this. Second leg. There is a person A who has availed advance authorization who will export goods. Now he procures goods from a domestic supplier B. Now this person can also take an advance authorization and procure inwards without payment of duty. That is the benefit of being a deemed exporter. I can also claim drawback for supplies made to this person. I am also in DTA. He is also in DTA, but I am claiming drawback. Now, in respect of this drawback, this slide says refund or drawback in the form of basic customs duty will be available. However, an amendment has been brought about with effect from 31st of October 2019. As per this amendment, a deemed exporter is also eligible for full drawback AIR rate. not just BCD rate, full drawback AIR rate. Provided that I have not taken credit on my inwards, obviously. So as a deemed exporter, I am eligible for taking an advance authorization license. I am also eligible for a drawback scheme, which was only available to an exporter. We have discussed that, section 74-75. But by way of notification 28/2015-20, dated 31st October 2018, the provision, refund of drawback on the inputs used in manufacture and supply under deemed export category can be claimed on all industry rate of drawback notified by the Department of Revenue from time to time, provided no survey taken by supplier of goods on excisable inputs or on brand rate basis based on submission of documents. So earlier the refund was, or the drawback was restricted to BCD part. But now I can also claim with effect from 31st October 2019, all industry rate or brand rate. So I will be taken at par with a proper exporter. That is the scheme for deemed exports. Now, this is one dispute in WTO which is not part of the syllabus, but you may refer to it in case this interests you. We have basically completed our discussion with foreign trade policy, and we have also exceeded the time limit. But in any case, I have to just discuss 2-3 latest amendments that may be part of your syllabus for November 2020 examination. One was this change of drawback rate for deemed exporter from BCD only to all industry or a brand rate with effect from 31st October 2019. The other one was extension of foreign trade policy and handbook of procedure till March of 2021, which I have already told you. The third one was that all types of exemptions given under EPCG, advance authorization or EOU to IGST and cess, which were limited to 31st of March 2020, has been extended to 31st March 2021. That is also there. That exemption has been extended to 21. So wherever, if you in your Board of Studies material are reading 20, you may read 21. Another important amendment is in respect of chapter 2 and chapter 1 of FTP, which we have not discussed because it was only basic in nature. Wherein earlier you could have imported gifts from outside India up to a certain value, basically 10,000 or 5,000 rupees gifts without payment of customs duty. So there is a provision under chapter 1 and chapter 2 of FTP wherein you could have imported gifts into India. So suppose my brother-in-law or my father-in-law lives outside India and he sends me a gift which is less than value 10,000 or 5,000, whatever is the limit. That amount will not be, or that gift will not be liable to customs duties. But what was happening was many Chinese websites and Chinese exporters were misusing these exemptions and sending goods to India for proper sale, commercial sale, and claiming them to be gifts. And that is why that exemption of gifts has been removed with effect from 12th of December 2019 and has now been restricted only to life-saving drugs, medicines and Rakhi. But not gifts related to Rakhi, so that Chinese exporters cannot use that exemption and say these are gifts related to Rakhi. So therefore they have restricted it to life-saving drugs and Rakhi only, not gifts related to Rakhi. Now, there is one question left which I have to cater to and then we will close. I hope the session was fruitful. In case of any query, you can reach out to Board of Studies and thereafter they will reach out to me and maybe solve the problem accordingly. I'll just take the last question that is pending on the questions portal from Bhavati Sukhadia from Vadodara. She says, sir, in first slide of status holder in PPT, it states that an applicant shall be categorized based on performance during current and previous 3 financial years. However, in third slide of PPT, it states that for granting export performance, at least 2 out of 4 years is necessary. Can you please explain the difference between the two? Actually, both are same. Board of Studies material is saying that for considering export performance, you have to see the current and the previous 3 financial years. And I have also stated the same. You have to see the current and the 3 financial years. But out of these 4, any 2 will do. Any 2 will do. In any 2, if you have achieved the export performance, you will be eligible for a status holder certificates. Thank you all for the patient hearing. We will close today. Thank you.